Okay, well, hi everybody. I hope you've had a good week since I've last seen you. We're getting oh so close, aren't we? Next Monday, of course, is the mid-sem exam for this unit for you guys. Again, just a reminder, multiple choice questions. There are 20 questions. Yes, you will get a formula sheet. I'll load the formula sheet up later this week, so you'll be able to see that. And in terms of preparing for the mid-sem, as I said before, the mid-sem is based on the lectures, the activity questions, the calculation activity questions, and also the readings from weeks 1, 2, 3, 4 and 5. Everything that's on Moodle basically is examinable. Okay? So therefore, that means that in terms of you preparing for the exam, you can be rest assured there will be some quantitative questions, and there will also be a number of what I will call qualitative questions as well. All right? So therefore, I'm not going to go into, well, how many of this and how many of that, and which week's this from and which week's that from. Right? The exam is based on your questions from each of the 5 weeks. Okay? So therefore, if you are prepared, then obviously there's no disproportionate number of questions from any particular week. I probably is the nicest way to say what I want to say. All right. So that being the case, last week we were talking about risk optimization analytics. And I just want to finish this off as part of obviously the week 5 materials. And you remember that we were talking about the fact that what we were talking about, if you might remember, was we were talking about the concept of unexpected loss and also of economic capital. Okay. Now, when firms suffer unexpected losses, then obviously we need to be able to collate those unexpected losses, whether they are coming out of the operating part of the business, whether they're coming out of compliance part of the business, whether they're coming out of strategy, but more importantly for our purposes, we need to be able to collate them as they apply to the financial risks that the firm is exposed to. Now, what we know, of course, is that when it comes to market risk, the unexpected element can obviously be captured by looking at what the VAR might actually be. And looking at the VAR, we might choose to look at the VAR at a 95, 99, 99.9% threshold level, but at least we can get a sense of what an unexpected outcome might be. When it comes to operational risk, you'll remember that I said that some firms proxy their level of unexpected loss by using 3 times the gross profit for the last 3 years, so they have to be positive gross profit, and then multiplying the average of those 3 years by 15%. Okay, so you calculate what it is, you work out what the average is, and then you multiply that by 15%. Then the other alternative is that obviously when we have things like credit risk, that in credit risk is a little bit different, because with credit risk, oftentimes we can actually still observe an expected level of loss, but also what we want to do is to actually work out what our unexpected losses might be as well. And of course, by knowing what our unexpected losses are in market risk, credit risk, operational risk, and then to that, if we added then funding risk and liquidity risk and other financial risks you can think of, then what we can do, of course, is we can then start to say, well, if I collate all those together, I must be able to get some sense of what the overall financial unexpected loss of the firm is equal to. Knowing what the unexpected loss is and what it's equal to is an important aspect for us, because in order for a company to maintain its credit rating, what they need to do, of course, is they need to hold sufficient economic capital that covers all of their unexpected losses. Not just their unexpected loss for credit, not just their unexpected loss for op risk, not just their unexpected loss for market risk, but the collation of all of their unexpected losses. Okay, they've got to hold sufficient equity that in the event that those unexpected losses were to be realised, then of course, obviously that would become a problem for us. So we would need to, there's a possibility that the firm could lose its credit rating, or further still, the firm might actually lose its value of what its amounts might be, in the sense of it might actually lose its own liquidity and therefore go into liquidation. So the premise is that if I know what the credit rating of a company is, I can actually identify a threshold level of, if you like, what the maximum amount of unexpected losses are that I should be able to sustain, and also what I'm able to do is then also to compare, obviously, whatever that level is directly to the expected losses of the firm, and then by doing that comparison, the capital difference, of course, represents the ECAP of the firm. Now, what some people do is they don't just do it in this particular way, they do it in a slightly different way. What they will often do is they'll look at this and go, well, when I'm trying to calculate what the ECAP is, given that I'm trying to get to these threshold points that are way out in the tails normally, that oftentimes companies will instead refer to the economic capital instead as actually being the capital at risk, and therefore they'll use an at-risk type methodology to actually derive what those figures could be. Now, what that means is that a company could use an analytical formula to calculate what the outcome could be, or alternatively, and therefore apply something like the delta normal type approach, or alternatively what you would do is, of course, delta normal is not a very good approach for operational risk or for what we've got here in terms of credit risk. So what we're probably more likely to do there is to actually do something that reflects something more like an historical simulation if we can't find an alternative calculation methodology. So one of the things that we got to last week, and then I stopped because I couldn't find the right file to demonstrate it to you, was I suggested you have a read of a paper that's available on the internet. Okay, it's not downloaded, it's not in the readings online, but it is accessible via the internet, and it's just basically one page. It's not going to kill you, it's just one page. And what this one page does is it walks through and explains obviously the difference between expected losses and unexpected losses that a person or a company might actually be exposed to. Now, the premise of actually looking at it in this way is that when you calculate as to what your unexpected losses are in credit, we've previously said, well, that's quite straightforward. It's just the EAD times the PD times the LGD. But when you start to stop and think about it, when we go to calculate the unexpected losses come about because of uncertainty associated with the EAD, with the LGD, and with the LGD and with the PD. And because there are unexpected possible outcomes associated with all those things, they also are correlated to each other as well. Therefore, we can treat it similar to, but not the same as, what you might do if you're treating this like a portfolio type setup. And that being the case, what we can do is we can actually have this very cumbersome and long-winded formula, right, that we could actually apply, which is just really a matter of just, and you guys love this sort of stuff, just load the numbers in and off we go. All right? Now, that being the case, right, well, that's a bit of a dog's breakfast of a formula to have to deal with. So what we can do instead is we can make a few simplifying assumptions. Okay, what we can do is we'll assume that the square root of the volatility of the LGD, it can be proxied by this here. We'll also assume that the square root of the EAD, in other words, the volatility associated with the earnings at default, obviously is equal to 0. Now, because of those simplifying assumptions, we actually end up with a formula that is a lot more robust than the one above. So in other words, if you go into that formula I just showed you and substitute, boom, 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 all those variables, and it actually does that in that paper, it shows you with the crossouts. It goes, this goes out, this goes out, this goes out, and then we're left with an alternative formula. And the alternative formula is much more user-friendly at the end of the day. In other words, what we do is we end up with, right, expected losses are still equal to EAD times PD times LGD, which we've talked about in the past, but the unexpected losses on credit now are going to be the value of what our exposure at default will be. So that could be the balance as it is right now, or it could be an expected balance based on what the balance might be in the future. And then what we do is we then multiply that by the square root of PD squared multiplied by, and there's that first formula substituted, right, the volatility of the LGD squared plus LGD squared, okay, multiplied by the PD multiplied by 1 minus the PD. Now, because of this formula here, right, what we can do is we can basically say, well, that formula there actually then collapses into this formula that's down the bottom here, which is very handy for us. Now, formula, right, let's do it in practice. That's the best way to understand these things. So let's assume that I've got a firm, and my firm, basically we know that the expected losses are exposure at default times PD times LGD, and we also know that when I look at the firm, that different financial products have different characteristics. So in other words, the exposure at default of a lending product is always equal to whatever the drawn portion is of the actual product, okay, plus any undrawn portion. So in other words, let's assume that I had a bank loan. The bank loan was worth $100 million. Then obviously the drawn portion will be the $100 million because I've drawn it. That's what's outstanding right now. But let's assume instead that I had an overdraft facility. And let's assume the overdraft was for $20 million. Well, let's assume that I've actually drawn 10 million of the 20 million. In that case, I've got a drawn amount of 10, plus I've got an undrawn amount also of 10. But at the end of the day, if I haven't drawn it, then it's not really a direct exposure at this point in time, but it's a potential exposure that obviously the person who's granted the loan might feel that they are exposed to. So what we can do is we can actually take the undrawn portion of the loan and then multiply that by some loan equivalent amount, all right? And therefore we actually have some figures we can use that can convert the undrawn amount into an equivalent undrawn facility amount. And the idea is that even though it's 10 million outstanding that's undrawn, when you apply the multiplier, it might actually bring it down to only being, let's say, $5 million that's actually overdraft undrawn. For derivatives, well, derivatives are a bit narky because with derivatives, we need to consider, obviously, what is going to be the replacement cost. In other words, if I had to replace this derivative in the market right now, And on top of that, there is also the fact of what is called the potential future credit exposure, which comes about because obviously with a derivative has a life between today and obviously the maturity of that product. Now, what happens is that in most derivative products, they converge over time to what the actual agreed rate is. But if I was to mark them to market, or if I was to value them at any other day, they might in fact have a different value. So what I can do is I can also calculate a thing called potential future exposure. And then just as a scaling metric, I then just, in practice, multiply that by a factor of 1.4. Now, a couple of other things that we know. We know that, of course, the PDs can be obviously looked at by looking at perhaps credit ratings and knowing what the probability of defaults are of companies that correspond to those credit ratings. The loss given default normally expressed as 1 minus whatever the recovery rate is. So in other words, if someone defaults and you can sell the assets, then you might still recover some money. So if I've got $100 million outstanding in a loan, the person's defaulted, they've got $50 million of assets, then obviously 1 minus 50% gives me the amount, of course, that I can obviously recover. All right, so then we come down a little bit further and we see that we can actually, through surveying, and this is figures that are taken from Standard & Poor's, you can actually estimate as to what happens when securities are fully secured, partially secured, or unsecured. And as you would expect, that obviously when things are fully secured, chances are your losses are going to be really small, okay, because you're going to recover a lot. When they are partially secured, obviously you get a bit less back. When they're unsecured, that in itself doesn't always mean that you'll get nothing back, right? Because just because the loan is unsecured and someone doesn't pay it doesn't mean they still haven't got other assets that could be sold off in order to obviously meet what the requirements of the loan might actually be. And you think about this for a moment, when companies go into liquidation, that oftentimes in that process of liquidation and administration, that the administrators will often basically sell off assets. And as they sell off those assets, that will raise capital that can then be used to pay off existing debt. And then eventually, once all the debt's paid off, hopefully the equity holders will then get something. But if the equity holders, if the debt's too high, the equity holders may in fact get nothing back in terms of the shares that they're holding. So here's just a couple of quick formulas that reflect the ones that I've shown you up on the board a little bit earlier. Now, let's assume that I've got a company. Right? And the company is just a vanilla, simple company, no different to what most other corporates around the world will actually look like. And I've got some accounts receivables, and the accounts receivables have a notional value of about $15 million. I've got some investments that I've placed on, obviously, as investments with banks and other institutions. And let's assume that that's approximately 16 mil. I've given some intercompany loans that basically in my supply chain, I've actually written some loans to a company that is actually a primary supplier of goods to my firm, and I'm concerned that if that firm doesn't continue to exist, then that's going to affect my company. So what I do is I do an intercompany loan with that company where I lend them money, so they owe me money at this point in time. If that happens, let's assume that the balance on that loan is 25 mil. And then let's also assume that we've got a intercompany loan as well, the second one, that's like an overdraft facility. And as an overdraft facility, let's assume that the current balance in that overdraft facility is 0, but the risk adjusted, if you like, adjusted for PP, you remember back here, we said that we've got to adjust for, obviously, the undrawn portion multiplied by loan equivalent. Let's assume that we've done that, and in doing that, we've come up with a figure of about $3 million. Okay, so all up, that facility obviously has a value of about 3 mil. Then we look at our derivative contracts, and we notice in derivative contracts that people owe us money by virtue of the fact that our derivative contracts are in the money to us, so therefore that means that people owe us money. And again, the replacement value of the derivatives is about 10 mil, and let's assume that the PFE amount, or the element that is the extra part, so obviously potential future exposure multiplied by 1.4, that part is then, back there again, okay, is then equal to 5. So what does this tell me? What it tells me is that for this firm, I've got a lot of credit outstanding. Right? And so most firms, when you break down their balance sheet and look at the activities that they actually do undertake, they do actually have a lot of credit exposure at the end of the day. And we know that credit risk, of course, is a big risk, okay? Credit risk is about money that is owed to you as a firm, not money that you owe to other companies, right? It's not your borrowings, that's their problem. If you don't pay, that's their problem. It's your problem as well, but it's their problem because they're the ones that are actually owed the money, right? So if you owe money to a bank, you are a credit exposure to the bank, okay? If you then lend money to others, or you give accounts receivable, or you place money on investments, that is money that's owed to you, therefore obviously that becomes your credit exposure as a corporate. So we've got notional values of accounts receivable, investments and so forth of 66 mil, and we've also got undrawn commitments, obviously, that are equivalent to about $8 million, which gives us an all-up EAD at a point in time of approximately $74 million. Well, let's assume, based on our $74 million, let's assume that we've analysed all of our different exposures that we've got, and what we recognise is that the standard of companies that are accounts receivable are roughly about a double B level, the investments are a double A, the intercompany loan is a B, the undrawn overdraft is a B, and also our derivative contracts are also roughly about a double A level. Also, the securities, some of them are partially secured, unsecured, or there's no fully secured ones here at all, obviously. All right. Now, that means, if you remember back on the first page here, we can actually map. We can actually map all of those. So a PD of AA would be 0.02%. An LGD that's partially secured would be 35%, and so forth. Right. So we can actually map based on the credit rating and the type of security that's offered as to what the PD and the LGD of these companies is actually likely to be. All right. Now, once we've done this, we can now start to do things. So firstly, we can calculate what our expected losses are equal to. So expected losses are simply, right, the exposure at default multiplied by the PD multiplied by the LGD. So therefore, if my exposure at default on accounts receivable is that I've got outstanding $15 million, and that most of those customers are double B rated, which means therefore the PD is approximately 1.10%, and also that those are unsecured, then obviously I've got an LGD of 55%, hence the expected loss on those is actually 90,750, which is just simply the multiplication of this by this by this gets us to 90,750, right? Really straightforward. And then what we can do is then we can say, okay, well, let's do the same thing, put it on repeat and go bang, bang, bang for each of the others. And what we find is that for our total portfolio of 74 mil, that we've actually got about $1 million of expected loss that's actually sitting there. All right, $1 million of expected loss that is actually sitting there. Now, most companies will normally take that expected loss off the value of what those assets would actually be. So for example, accounts receivable, right? What you would do is you would hold the asset at its full value, but then what you would do is you would take off, right, the expected loss that you thought you were going to make, so that when you actually book the value into your balance sheet, that the amount that goes into the balance sheet reflects that adjusted value. Now, this is one of my big bugbears, is that most companies don't do this properly. They let the accountants tell them just apply 2%, right? Well, if I applied 2% of this figure here, 2% of this figure here is only about $30,000, all right? But if you notice, the expected loss is actually about $90,000. So in the event that if you were to have basically all of your customers were to get themselves, because we had a giant recession and nobody was able to actually pay, etc., right, your expected losses, once we start to come out of that recession, would probably be somewhere around about the 90,000 mark, all right? The reality is you might actually suffer big unexpected losses because obviously some of the customers may actually fully default during that period, which obviously would be a disaster for you. So this is all very nice. This gives us a view of what the aggregate is for obviously our expected losses. Now what we can do is then we can come and try and calculate what our unexpected losses are going to be equal to. So for our unexpected losses, we use the formula that was the one that I showed you just before, EAD times PD squared multiplied by LGD squared, the sigma LGD squared, right? plus LGD squared multiplied by PD multiplied by 1 minus PD. Now, when we come to use this formula, what I can do is, you can see I've got my notional values, I've got my undrawn commitments, I've got my EAD, I've got my PDs, my LGDs, and then what I've done is I've gone and I've calculated what my sigma LGD squared is equal to, right, which of course is the value of the LGD multiplied by 1 minus the LGD divided by 4, which was the formula from earlier on. You can see it's in the middle there, it's in that bit just there, okay? I do the same thing for my PDs. The PDs are just simply PD multiplied by 1 minus the PD, and then we know that we've already assumed, to get to that formula, we've already assumed that the EAD volatility, so the sigma of the volatility of the EAD, is equal to 0. In other words, we're confident that our EAD figure is what the EAD will be if the default was to actually occur. So what we're more or less assuming is that given the current balances, if we lost everything overnight, what would it look like between now and tomorrow morning? All right? So that being the case, we can then just load all those formulas, right, all those inputs into this formula here, and when we do that, we'll calculate an unexpected loss. There will be an unexpected loss for receivables, for investments, for the intercompany loans, for the undrawn advance, and also for the derivative assets. All up, when I aggregate just those in simple terms, the unexpected loss is about $4.65 million. So what is this telling us? What it's telling us is that, think about a distribution that looks a little bit like, it goes up and then it's got the long tail on it. What we're basically saying is our expected loss was about $90,000, right? Or the right figure. Our unexpected loss, was about $1 million, all right? Our unexpected loss was $1 million. But when we take into account the unexpected loss, given the unexpected loss is the tail event, the thing that's going to happen out here, right, then at that point the figure is telling us that if I simply added them all up, it would be basically about $4.65 million. So in other words, if I assumed that I had a totally undiversified portfolio, it would essentially be somewhere around about $4.6 million would be the figure that would be what would come out. Now the reality is that in a lot of cases, right, when we've actually got, if you like, different levels of correlations, okay, so let's assume that we've got correlation here, right, that is going to reflect, that's right, so what I've done is I've applied correlation equal to 1 and on the offside is 0, we get an all-up figure, obviously, when I apply the correlations, that comes out at about 5.9. Now, what happens if I was to, just let me double check this is set up to go, good. What if it turned out that in fact there was actually some correlation that actually existed between all of those assets? Then what could happen, of course, is that the figure could end up starting to become bigger, 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 all right? And obviously I can't put it in as 1 for everything because they can't all be positively correlated perfectly to everything in the thing. But let's assume that we had a figure there, let's put it in at 0.75. You can see that this number gets pretty big pretty quick. And then also, let's assume that there was to be a negative correlation. Oh, -5 is not going to cut it. Go back. So about a negative correlation, then that of course pulls the number back down again. All right? So what does this all tell us? What it tells us is that the expected losses obviously don't take account of the interactions that exist between each of the different assets in the portfolio. Okay? The unexpected losses do take account, firstly, of the interactions between the PDs, LGDs, EADs of each of the different assets. But also what you have to consider is, of course, that each of those assets is in themselves correlated with each other. So in other words, if it was to be that the unexpected losses of accounts receivable was increasing, wouldn't it also stand to reason that therefore the potential losses that you're going to incur on the loan to a counterparty, who is also probably one of your accounts receivables as well, is also going to probably be positively correlated at the end of the day? All right? So you do find that loans do tend to follow, and credit does tend to follow the business cycle. All right? And so therefore, you generally find that most correlations are typically positive. Okay? It's very hard to get diversification impacts when you've obviously got this as an outcome. Okay? So I'd suggest just go and spend a little bit of time, have a look at obviously the way I did the calculations in here, and then obviously that might help some of your understanding. You never know, you might need that for your assignment as well. All right, so let me go back to where we were last week. We were down here, we were talking about, okay, very good. I think from memory, I think where we got to last week was we finished talking about economic capital, if I remember rightly, okay? Did we start to talk about, I don't think we did. Did we start to talk about RAROC? I don't think we did we? Did we talk about RAROC last week? Which slide number did we get up to, do you remember? We did talk about RAROC last week. Do you remember what slide we got up to last week? Can you? 26. Oh, good, 26. All right, that's good. That's right, 26 is good. Okay, that's fine. Thank you. So we got up to that one. Yeah. Okay, good. All right. Okay. All right, everyone. So let's keep going. All right, let's keep going. Okay, I talked about risk indicators in the week 4 stuff, so I'm not going to go over that again, obviously. But nonetheless, just as a quick refresh, a lot of firms, what they do is when they look at the early risk indicators that are actually out there, they'll look at both internal and external variables that are indicators of change. In other words, they will look at factors that are changing outside and inside the firm, and then they'll apply those to develop an understanding of what the risks are that are likely to change within the firm as a result of those attributes actually changing. And a good example of that, and I think I used this in the past as well, would be that if I was in the construction business, okay, and building office buildings and apartments, I would want to have a look at new buildings approvals as a leading indicator as to whether or not there is actually going to be continuing growth, if you like, in that particular industry. If I saw a massive drop-off of that indicator, that would suggest to me that apart from the buildings we're building on right now, that chances are into the future that there might not be as much work around, and if there's not as much work around, then chances are that means that the property prices themselves are probably going to fall somewhere in the near term as well. And if property prices start to fall, that leads to a chain reaction, which then means that your ability to get credit as a property developer basically dries up. Your ability to get credit as a property builder starts to dry up, and then eventually, of course, that then flows into the rest of the economy, because all these people that you see around the university doing all these buildings on building sites suddenly find themselves without a job. All right, and so that then increases unemployment and so forth. All right, so can you see how one thing leads to another, leads to another, leads to another? All right, and it's through your experience that you develop those networks and those lines of how it will actually affect, all right? But for now, it's important that you understand that obviously some of those indicators could be external to the firm and some of them could be internal indicators to tell you that you're in trouble. If you start to notice that your cash at bank figures are obviously starting to get low, all right, you start to experience some liquidity problems. Then, of course, you need to take action to do that. Well, what action are you going to take? And that then precipitates, obviously, what sort of action you might be able to take, because if you have very low liquidity figures, you might actually be in breach of some of your debt covenants, or alternatively, you might not be able to get the next overdraft facility, or you might not be able to sell some of your current assets because you need to use those current assets in order to obviously produce goods to continue to make money. So it's a very cyclic sort of thing in terms of how it tends to obviously play out at the end of the day. All right, so the second type of analysis that we typically do when we do, if you like, this sort of work is we will often do what are called risk optimization analytics. And the risk optimization analytics, remember I said easy maths, a little bit harder, and then blow your socks off maths, right? Well, probably what I just showed you is in that sort of realm of blow your socks off type maths. What I showed you was the unexpected losses, all right? But nonetheless, even in this space, there can be some little complications that might come up as well, but we'll deal with those as we get to them. All right, so in terms of risk optimization analytics, what we're doing here is we're trying to assess maximising of returns relative to risk. And to do that, we want to make sure that as a company, as I undertake the activities that I do, that I'm in fact going to get the best possible outcomes with regard to what the outcomes will be. To do that means, of course, that I'm allocating capital, and as I allocate capital, I want to get the best possible return on that capital. Yes, I use the capital to buy assets that generate the return, and we could look at return on assets and so forth, or return on invested capital as proxies, but the reality is that if you use a return on equity type measure, all those three measures, return on assets, return on equity, return on invested capital, all suffer from the same problem. They all suffer from the problem that there is nowhere in there captured anywhere the risk that is actually being undertaken. So a better approach, a more informed approach, would be to obviously adjust for the risk that we are actually exposed to, right? A risk-adjusted approach, in other words. And to do that means, of course, we're going to have to calculate what's called a risk-adjusted return on capital. Once we've worked out what our risk-adjusted return on capital is, we can then use that as a proxy to then tell us something about what our true economic profit or economic income actually is. And economic income differs from, and this of course is risk-adjusted economic income, differs from obviously just your normal net income that you would otherwise see in a balance sheet, or in the P&L I should say. Okay, so risk optimisation analytics, as I was just saying, there are inherent problems with the use of obviously ROA and ROE, and of course when we go back and you look at sort of your value maximisation stuff that we typically talk about in finance, a lot of that valuation stuff is centred around the idea that you want to maximise returns to shareholders. You do that by generating the highest possible net profit and then dispersing that net profit back to the shareholders, and then also paying off obviously your bills as you need to, okay? But the trouble is that when you look at that as a way of measurement to think about whether or not the firm is performing well, the problem with that approach is, of course, that it's basically using accounting numbers to drive what those outcomes actually are. And some of those accounting numbers, for example, net profit, well, net profit in itself obviously is a distorted number because it contains lots of cash items. When I look at total assets, there are a number of accounting items that are sitting in total assets as a way of return. When I look at equity, equity in itself has got things like retained earnings and reserves and things like that. And therefore, again, it can distort what obviously we mean when we talk about actual equity and obviously the return on equity. So that being the case, we need to come up with a couple of ways of thinking about things, and because what we might do is, well, when we look at any project, because we're always trying to say, well, look, so long as obviously the return on investment activity is bigger than obviously the capital invested multiplied by the cost of capital, as long as that's greater than zero, that we should always proceed. But because that approach doesn't take into account what the actual risks are of the project, and also the risks associated with both the financing decision and also on the return side as well. So what can we do? Well, pretty straightforward at the end of the day, really. We can actually calculate a measure called RAROC. And RAROC can actually be calculated in one of two separate ways. It can either be calculated as your risk-adjusted income divided by economic capital. Right, remember economic capital is the one we've been talking about, okay? Or alternatively, some books and some places will refer to it as risk-adjusted income divided by capital at risk, okay? And when you see it expressed as capital at risk, what it's basically saying is that the capital at risk is a proxy, obviously, for what the economic capital of the firm actually is. So it's basically, it's just an interchange of a term. It's like I said earlier that sometimes some people refer to economic capital, its proper name, as capital at risk because of the way that it's actually measured using a capital at risk type approach. So what we find is that RAROC is typically defined as your net economic income of a business scaled by obviously the risks associated with the capital that's at risk through virtue of what the company is trying to do and achieve. Let's assume that we were trying to look at a company and trying to work out, well, how could I actually come up with some sort of sense of what this concept of risk-adjusted income is equal to? Well, the trouble with this approach is this, that if I was looking at normal income, just normal income, right? It would be revenue minus expenses would be gross profit, okay? Minus our operating type expenses like rental and administration, marketing costs and so forth, right? The SG&A type cost, as some people call it. You take that off, you've actually got a figure called EBITDA, right? Earnings before interest, tax, depreciation and amortisation, or other allowances, some people say. Then what you would do is you would then, from the EBITDA figure, you would take away all the accounting entries, and then you would have the EBIT figure. And the EBIT figure is the figure that finance people get really excited about. Okay, it's the figure that oftentimes you'll see pops up in a lot of valuation models and so forth as well. Then, of course, what we need to do is, from the EBIT figure, we've got to take away our interest expense, and then we take away from the interest expense, obviously, then we take away and calculate what our taxation will be. Once we've done that, once we've taken away the taxation, what are we left with? Well, what we're left with, of course, is the net profit of the firm. All right? So we've gone from gross profit to EBITDA to EBIT down to net income. All right? Nowhere in amongst all of that is any adjustments for risk. Nowhere anywhere in that line is any adjustment for risk. So what we've got to do is we've got to start adjusting for risk. So how are we going to do that? Well, what we'll do is we know that when I calculate economic capital, that economic capital runs from where the expected loss is to where that threshold point is in the tail. So therefore, obviously, when I'm trying to adjust the net income, I'm only interested in adjusting the net income for expected losses. So I'll adjust the net income for any expected losses that are likely to occur. And then once I've adjusted it for obviously any expected losses, what I'll also do is, let's assume that a firm at the moment holds $100 million of equity capital. And let's assume that its economic capital requirement is only $80 million. So in other words, the risks that it is taking are not as large as what the actual firm itself has in equity capital. Right? So the firm's got $100 million of equity capital, right? And when I work out what my economic capital is equal to, the number pops out at 80, so I've actually got headroom of about $20 million of economic capital, right? Well, you might say, well, that's a good thing. Tick, that's a really good thing. Well, yes, it is a good thing. Congratulations, it's well done. What it tells me is, though, that a firm is not actually fully utilising the actual capacity of what it has in terms of equity. There's $20 million of equity that's still sitting there that it could have actually been getting a return on, that at this point in time is not actually being utilised to generate that return. And that being the case, what I would then expect is I would want to do an adjustment for obviously that when I'm considering as to what my risk-adjusted income is. So in other words, what I'll do is I'll calculate what my economic capital is, compare that to the level of equity, the difference between those two. If the equity is higher, that means I've got too much equity relative to the risks that I'm taking. Even though I might be risk averse and think that's a good thing, right, I'm actually going to punish what my expected risk-adjusted income will be by actually multiplying the number that I have as the difference, so equity minus economic capital multiplied by the risk-free rate. Okay, so what I'll do is I'll multiply it by the risk-free rate. And by doing that, what I'm effectively doing is I'm putting a cost against the firm for obviously the fact that I've got this equity capital sitting there, but of course, in terms of it, the fact that it's there, it is actually a benefit to the firm, right? It is actually a benefit. Why is it a benefit? Because obviously the fact that I've actually got that extra bit of headroom is obviously not a negative to the firm in the context of it gives me a buffer, but at the same time it's not actually earning an income, so therefore I'm going to obviously make it do so. At the same time, as I said earlier, you can look at it through a lens that says, well, I'm underutilising. And in fact, if a company was actually allocating, let's say, to a business unit 100 million and they're only taking $50 million worth of risk, then you'd find that that company would then withdraw $50 million of capital out of that business unit, right? Because obviously if I give you 100 mil to use and you only use effectively the equivalent of 50 mil, then I'm sorry, you're not taking sufficient risk for what we're actually allocated to capital, and then I'll pull the capital back. All right, and so this becomes a method we can use to assess that. So can you see that now what we've got is revenue minus expenses minus expected losses plus income from capital, right? And the income from capital is that difference multiplied by the risk-free rate. And then I divide all of that, of course, by economic capital. Now, this risk-adjusted income still needs to include things like, you know, the non-accounting items like depreciation. It's still got to include interest expense. It's still got to include all the other things and taxation as well. It's just that we end up with a couple of other little adjustments that happen on the end. And I've uploaded for you onto the LMS this morning a little example that actually shows how you can take a P&L statement and adjust it to actually calculate what the net expected net adjusted income will actually be equal to. All right, so you can take one and then you can calculate what the other will be based on that information. All right, so when you do your adjustments to net income, right, the sort of things that you should be thinking about, well, here's a list of some of the things you should be thinking about. That obviously expected costs of risk being undertaken, so make sure that you've actually captured all the expected losses that might occur. Make sure that if there are any, and this sometimes happens in some years, there might be one-off extraordinary or abnormal items that are going through because the company might have sold assets and made a big loss on it, okay? Qantas did this a few years ago here in Australia, where they actually did a big rewrite on the value of all their assets, and they took it as what's called a big bath in accounting, which basically means that what happens is, right, that you deplete what the value of your assets is, you run it through your P&L in one hit, and that way you don't have to then, you can then re-emerge like the phoenix coming out of the fire, right? You can actually re-emerge subsequently as make big mega profits, which is what Qantas has actually done. So Qantas suffered for about probably 6 months, and then at the end of the 6 months they basically re-emerged out and now regarded as a highly profitable company again, right? Because they took that bath on their assets on the way through. Now those big baths on assets and any other extraordinary abnormal items, if we want to assess the risk of the firm, yeah, that's important, but we want to understand it from a sustainability point of view, right, in terms of what the firm is doing. So what I would do is, in fact, I would actually suggest that you should actually remove any extraordinary or abnormal items. And often in the P&L, what you'll find is they'll express the P&L as being down to the net item line, and then they'll often have the extraordinary abnormal items below that just to show what the impact of those will actually be anyway, right? So we just need to make sure that we take those out. If there's any goodwill that's being amortised, right, that needs to be removed, as also would be the case that if you are actually amortising any credit losses, I would suggest that they need to be taken out as well, because obviously the credit losses should just reflect what the actual expected losses actually are. So they shouldn't then just be amortised over time as some sort of benefit. Also, if there are any one-off huge tax losses or windfalls that you make, obviously they need to be considered. And then also any servicing costs or internal transfers of capital that might affect as to what your equity might actually be, they need to be considered as well. In the reading that I gave you, the reading that is by that one, Francis DeWert, he actually talks about some of these factors in that reading, so it's worthwhile to just have a look at that. Okay, if you're a little bit confused by what I'm talking about, which I hope you're not. Okay, so, all right. Now, as a simple rule of thumb, we've established that obviously the risk-adjusted income divided by economic capital, or the risk-adjusted income divided by economic capital, right, becomes obviously a really good measure as a risk-adjusted return on capital. So therefore, if I'm actually able to generate a RAROC, and the RAROC is, of course, that risk-adjusted return on income divided by, right, capital at risk or divided by economic capital, if that number is actually larger than what your cost of capital is actually equal to, then you are generating money for the firm. That's a good outcome. We're all happy if that happens, all right? If your RAROC is lower than your cost of capital, we've got a serious problem because it's actually eating value from the firm. It's actually destroying your firm. If you have a business unit that is underperforming in this way, right, then obviously that's not a happy outcome for anybody. So what we basically say is that, right, if the economic income or profit that is being generated from a business line is greater than zero, then value is actually being created within the firm. Now, let's compare. If I use the accounting type approach, the accounting approach would say, well, net income profit is just the difference between the return on a company's available capital and its opportunity cost of capital, whereas the economic income profit approach is actually a direct measurement of the amount of risk-adjusted return that's created in excess of, obviously, the capital is required to support the firm. So it's actually a better measure because it's the economic income measure is a far better measure because of the way it's actually set up and measured. So we can actually calculate what we call the economic profit, or in some book you'll see it's called the economic income of a firm, as being the risk-adjusted income minus the WACC multiplied by the total economic capital of the firm. All right? In other words, you could re-express this as risk-adjusted income minus the WACC multiplied by the total capital at risk within the firm as well. Right? Would be equally as applicable. Now, what you've got to be careful of is this. The WACC that needs to be applied must be the WACC at the group level, not at the business line level. Okay, it should be at the group level because the group is funding all the activities of what are going on. So the WACC should reflect what it is at the group level. Also beware, because some books, and I know this will happen, no doubt this will happen, I'll get this in the assignments I'm sure. Some people will find books that will tell them that economic profit is just net profit minus the WACC multiplied by economic capital, right? Those books are wrong. They are wrong, all right? What they've actually calculated is not RAROC, they've actually calculated what is called RORAC, R-O-R-A-C, right? Which is return on risk-adjusted capital. Right? So in other words, what they've done is they haven't done the risk adjustment to the net income, which is required to do this properly. All right? Risk-adjusted return on capital. Think about what's going on here, right? And if I use RORAC, I'm taking a return based on net income and then obviously putting it relative to obviously the economic capital. Right? And obviously that's not what we want to try and do. So just beware on that. If you find one where it says net income minus that there, right, that's wrong. It must be your risk-adjusted income that needs to be the figure that actually gets applied and used. All right, so if a firm is looking to allocate its capital, right, is looking to allocate its capital, what you'll see is that there are a few different approaches that we can obviously use. So as a firm, what we know, of course, is that we do lots of activities, and each of our activities require capital in order for them to be able to function. Right? And the capital could be in the form of debt financing or in equity financing, whatever else, but nonetheless we still need capital in order to actually be able to operate. That being the case, what happens is that for most firms is that the firms in themselves are highly capital constrained. Right? They might have projects that basically could be worth $500 million, but they've only got access to $250 million of capital. Right? And therefore they have to make decisions about which project are they going to take. Right? And when they do that, they need to have a way of being able to assess those projects. Now, you'd go, but that's just NPV, isn't it? Well, yeah, it is NPV, but this is like NPV on steroids. Right? This is better NPV than just vanilla NPV. Right? Because what this approach does is this says, okay, you need to assess each of your projects not just simply in the sense of, is the NPV greater than zero? Are the projects mutually exclusive? Oh, which project do I choose? All right. What you've got to do instead is you've got to say, well, I've got all these different business lines, which in themselves are the projects. How much capital should I be allocating to each of those different business lines to get the best possible return, both individually within the business lines, but also overall to get the best possible outcome as well. Right? So I want to get it at the group level, and I also want to get at the individual business level. So that being the case, there are a number of different ways we can think about this. One is that we could use what is called undiversified economic capital, and the idea here is that what you would do is you would basically go through a process. 1 second, I'll just go back. Okay, so what you could do is you could say, well, look, if I had undiversified capital in my firm, what that essentially means is that each of my business units, basically there is no relationships that exist between the business units. Each of them is almost like an independent business unit. There is no requirement that one business unit is related to the other, one business unit is not correlated to the other, one business unit is totally independent of what the other business units are doing. Okay? Pretty hard to think of a firm where that would be the case, because it's almost as though you'd need to have firms that are just doing totally different things that have no economic bearing or relationship to each other in probably totally different geographies and totally different setups in terms of how they're actually managed, all right? So, that being the case, what we can say is that the economic capital, the total undiversified economic capital of a firm must be equal to the sum of, obviously, what the capital at risk is in each of the different components of the firm. So if I had two components, obviously one with 100 of economic capital, the other of 50 of economic capital, add those two together, 150 total, all right? Now, that's okay to think like that, but the reality is obviously quite different. The reality is that, in fact, you're always going to find with any firm that the board of management or the board is not going to sit back and let a firm basically just have these disparate projects that have nothing to do with what the firm itself is obviously trying to achieve. So what the board will do is it will no doubt have projects where there will be elements of these projects that will be correlated to each other. And the correlations in themselves then create a form of diversification, which then has the impact of actually lowering what your economic capital requirement is actually going to be. So in other words, I'll go back to what I said a moment ago. I might have a firm that's got 100 in one place, 50 in another. But when I treat them as basically independent projects, right, 150 is the amount of equity capital I need to cover those two projects. But let's assume instead that those two projects have a correlation with each other, such that that correlation causes, of course, that value to obviously decrease. In other words, let's assume that they're negatively correlated with each other. In other words, when one business unit is going up in value, the other business unit is going down in value, all right? And so therefore, vice versa. And it could be, to give you a sense of that, I could be a company that's in the business of doing sales, but at the same time I might have another part of my business that is basically like, it runs like a collections agency. And so therefore, if times are good, the collection agency doesn't make a lot of money. But the sales side of the business makes lots of money, right? But when times are bad, what happens is, of course, the sales come off, right? Because obviously people are starting to default and not continue with the sales in the same volume. But of course, the collections part of the business takes off at that point, because people then start to default and you've got to go out and chase down the money that's owed to you. So suddenly we get a firm that, you know, two branches of the firm sort of work in opposite directions in terms of their profitability, subject to where we are in the business cycle. You might say, well, why would you do that? They might offset each other. No, not likely. It's more likely that obviously, yes, there will be negative correlation, but it's not going to be perfectly negative correlated, right? It's going to have some value of negative correlation, but won't be perfect. So that brings us to the idea that, of course, we can then have diversified economic capital within the firm. But also what we need to be able to do is to work out what our marginal contribution of capital is to each of the different business units within the firm as well. And to do that means that, of course, we've got to understand what is the marginal contribution of each part of the firm to the whole firm. So if I had a firm that had 3 business units, what I would do is, 3 business units, to understand what Group A is doing, what I'd do is I would look at what the performance of the whole firm is, and then I would take away the performance of sections 2 and 3, and what is marginally left must be what the contribution of Part A is equal to. And then secondly, if I wanted to know the 3rd business unit, I would look at the whole firm first, and then I would look at sections A and B, and then take that away from the whole firm. That tells me what section C must be doing. And then similarly for B, you'd look at what A and B are doing relative to the whole firm, and again that would tell you what's going on. Okay? Now, So I need you to be able to think about and to see how these sort of methods are actually applied, and because in the notes that you've got, you of course have already got those things already set up for you. Very good. So I have one last thing I want to show you, and then we're going to have a break, okay? One last thing to show you, then we're going to have a break. Now, let's assume that I've got a company that is currently operating with two business units. One in Melbourne, one in Hong Kong. Yay, okay? So, Melbourne, Hong Kong. The company has got assets, the Melbourne part of it has got assets of $250 million. Hong Kong operations have $100 million. The allocated capital that I've allocated to this business to fund those assets, right, is $50 million in Melbourne and $20 million in Hong Kong. As a proportion, obviously, I'm basically a lot more leveraged in Melbourne than what I obviously must be in Hong Kong. Then what I do, sorry, I'm proportionally the same amount of leverage in both, it's just that it looks different because of the size. Let's assume that we've calculated the net income, that's the normal P&L net income, all right? And we make $6 million in Melbourne and 2.75 obviously in Hong Kong. And then I do a calculation for risk-adjusted net income, and I end up with a figure of, let's say, $3 million in Melbourne and $2 million in Hong Kong. And why would the number be lower? Because remember, we take away the expected losses. Okay, we remove the expected losses, so that's likely to drive down what that number could actually be. And then, of course, we look at, well, based on the risk that this company takes, what is the economic capital that's required to support each of these business units? Okay. This is up on the internet for you on the LMS as well. I'm pretty certain I uploaded this morning as well. I'll have another look. If I didn't, please tell me and I'll make sure it goes up. All right, so then what we do is this. We do the accounting type thing, right? We go, okay, well, return on assets is just, and return on capital, well, that's just simply, obviously, the return that we get from net profit relative to assets, relative to equity, right? Very simple calculation to come up with those two figures. But when I want to calculate the RAROC, I need to take my net risk-adjusted income, right, which, for example, in Melbourne is 3 mil and in Hong Kong is 2 mil, relative to, obviously, what's happening in terms of the economic capital figure. So suddenly I can now calculate exactly what my RAROC outcomes are going to be. Now, let's assume for the moment that also what I want to do is I want to calculate what my economic profit is. So my economic profit reflects, of course, the risk-adjusted, it reflects the net risk-adjusted income minus the WACC multiplied by the economic capital, all right? And let's assume that the WACC is 12.5%, and therefore I can now calculate what is the economic capital requirement, or the economic profit outcome for each of those two different business units, right? You can see that obviously in this particular case that Hong Kong is obviously underperforming relative to Melbourne, right? Melbourne comes out as a positive number, and of course Hong Kong comes out as a negative number, negative 1.6 dollars or percent at the end of the day. All right, now, that's the same one. Is that the same one? Bear with me for a tick. It's the same thing. Right, now, all right, that's why I did that one. All right, so let me just go back and understand what's happening here again. What I've done here then is I've said, okay, well, that's looking at the individual business units, okay? What if I wanted to know for the firm as a whole, right? So for the firm as a whole, right, total assets, total capital, total net income, total risk-adjusted net income, and total economic capital, right? So there's all your aggregations that are going on there. Again, I can obviously calculate what the return on assets, return on equity is going to be. And then, of course, again, I can now calculate as to what the risk-adjusted return on income to economic capital, the RAROC, is for the firm as a whole, right? And you notice that obviously as a firm as a whole, it's going to be the sum of the two individual elements all added through and then divided by each other. The interesting thing is that when you do this and you calculate it as a whole, you can then compare. You can go, well, look, the RAROC for the firm as a whole is 11.9%, but obviously in Melbourne, it's 16.67, which suggests that obviously you're getting a much better risk-adjusted return, obviously in Melbourne, relative to Hong Kong, that's only generating an 8.3% return relative to the firm at 11.9. Okay, and then what happens is, of course, when I then calculate the economic profit, the firm as a whole is not really going that well, but is actually being very strongly supported by obviously what's happening in Melbourne. So before you even think about, well, what's the next calculation, what does this tell us about this firm? What it tells us is that we need to do something about what's happening in Hong Kong. Right? And that could mean that we might have to perhaps sell off the operations in Hong Kong. Or alternatively, we might decrease our exposure to Hong Kong and increase our exposure in Melbourne. Right? Can you see how you can start to play with this now? Right? And by playing with it, what's going to happen, of course, is that if we know that for every dollar of economic capital, we know what the risk-adjusted income is that obviously comes off that. So for every dollar, I make 16 cents, obviously, in Melbourne, relative to only 8 cents in Hong Kong. Then what I'm probably more likely to do is say, well, let's cut back on the amount of capital that we put into Hong Kong, and then basically look to put that capital into Melbourne. The other alternative is we might look at these figures and go, well, hold on a minute, there's another thing that's actually standing out here that's actually quite an important figure. If you look at this here, the total assets that obviously the firm has, right, is 250, total equity at 50, but the economic capital is only $18 million, right? Whereas in Hong Kong, where we've got 100 million of assets, okay, and we've got 20 million of capital, the economic capital figure is actually bigger than what the capital is that's actually being allocated. So what does that tell you? If we've allocated capital to part of the business, we've allocated equity capital equal to 20, and the economic capital, or the unexpected loss, if you like, that we're incurring is equal to, what, 24 mil, what does that tell you? We're actually making more of a loss than what we've actually put in as equity. Yeah? So it could also mean that maybe rather than actually shutting down Hong Kong, we might be able to go the opposite way. We might be able to rebalance by perhaps putting more capital directly into what's happening in Hong Kong, and then using that capital as a way to then fund some better risk management techniques that can lower what the unexpected losses might actually be. So you might be able to actually play around with the figures and come up with some strategies that you could use to obviously move these outcomes about. I think in the work I've given you, the calculations for week 5, there is I'll walk through a big example there of how you can actually do what I've just been talking about, but doing it on a bigger scale, all right, to just give you a real sense of how you can apply that. Yeah.
Just a quick question before you close it. You already got the economic capital on the table.
Yep.
Why in the last step you calculate the economic capital?
Economic capital. Okay, economic profit we calculate. Yeah. Economic profit.
The second you calculate the economic.
Oh, sorry, that's a typo. That should say economic profit. Yeah, should say economic profit. Yeah. All right, so guys, let's have a break. If we can all be back in again by, let's see, it's just coming up to 1:15. All right, so if we can all be back in at 1:25. All right, 1:25, and I'll start again. Hello, how are you going?
It's just this one example we walked through. So said unsecured, but that doesn't really match up with the LGDs, because even though that's unsecured, it's like the 4 and 15%
only
to us.
15%, is it?
Yeah, and then
okay, well
partial secured one equivalent,
okay.
unsecured, and then
Okay.
maybe just I don't know, because volume.
Yeah. So I actually use those percentages.
Yes.
Right, so why don't you just change those two around? Right, change those. Yeah, just change those around. Yep. That's me changing my numbers and changing stuff around. So, hello.
I got a question here. So, do you need to minus the expected loss and then minus the income?
No. You take off the expected losses, And then because if I've got
I'm considering like the opportunity class from these students we have. Like,
Oh, okay.
The access.
Yeah, no, I know what you're saying. No, but remember though that the fact that you're actually holding more capital than you need is actually a benefit.
But if it says the amount we really need it,
Yeah.
No.
No. Think about it this way. If I'm running my firm and I'm only taking risk up to say, $40 million, and I've got $80 million of capital sitting there, I'm underutilising that risk, right? But what's happening is though I've still actually got the equity. It's not like I'm foregoing the benefit of what I could have got as a return with the equity, right? The other 40 mil, but I've still got it there. So it's actually a buffer. So it's a benefit to me by being on buffer.
So you mean the access capital we hold is kind of
Yeah, it's a benefit to me because if that equity is not actually being put into use, then it's not at risk.
Okay. So you save the fee from
That's right.
And also about the first example you're showing us about calculating the loan. I thought the undrawn part of the loan should be multiplied by the LEQ, like the certain number that you put in the loan, but you haven't.
Can we pull up? I'll pull up.
The first example.
So what are you saying? The accounts receivable? Which one? That one there? The intercompany? That one there? The undrawn one? Yeah.
So there's 3 million.
Yeah. Well, hold on. Let's go back to the beginning. So we've got the EAD figures. Right. So 3 million. He's got a balance of 0 and an undrawn amount of 3 million. And what I'm saying is that let that $3 million there, let that reflect, right, the adjustments that we talked about earlier.
So just assume
Yeah, so just assume I've already done the adjustments.
assume it.
Yeah, so just assume I've already done that adjustment there, right? So we've got, right, the drawn portion of the loan, in that case is 0, right? The undrawn portion of the loan is maybe whatever it might be, right? And I've already taken that figure there, and I'm saying that figure there is actually equal to $3 million.
So you've already done the work. Like
That is correct. Look, you can actually there's a table in Basel II that actually allows you to actually see what the different LEQs are for different types of products. That's too complicated for what we want to do.
And also the derivatives, we haven't multiplied the 1.4, is that also you've done?
I've done the same thing. Okay. I've done the same adjustment there. I basically said, well, look, you've got the replacement cost, which is the value, right? And then I've said, well, obviously to that, you need to add, of course, the 1.4 multiplied by replacement plus the PFE.
Okay, so the second step.
Yeah, so the second figure has already done that for you.
Separately multiply one. Okay,
Yeah.
got
I mean, I could have set the spreadsheet up with the different columns, but it's the thing I'm trying to teach you is the end product rather than the front end, if you know what I mean.
Well, just why the economic is naturally the capital risk.
Sorry, say it again.
So what's the relationship between the economic capital?
Oh, okay. That's a good question. Okay, we'll go back to the slides. Right, that's a good question. All right, so, right, you're happy with that being the notion of the economic capital?
Yeah.
Yeah, okay. And therefore we want to calculate, if you assume that that's what the economic capital is equal to, and let's assume that the threshold level we're using is 99.95, right? What does this tell you? How could you calculate the 99.95 level? What could you do?
We can use it to calculate.
Well, couldn't you use a bar type approach to do it? It's a bar, isn't it? Because it's like a bar in the sense that it's the tail of the distribution. You've got 99.95% of the distribution is below that amount there, right? And what we talked about when we talked about VAR was that you can use VAR to look at the value of financial instruments, to look at your earnings. You can also look at, obviously, the losses that you might incur as well, right? And that would be your capital at risk. Your capital at risk, because it's the amount of capital that you're placing at risk right? And this is obviously using a bar type approach to estimate what that capital at risk will actually be. That's correct. That is absolutely correct.
Okay, so which means, because we got the same problem.
Yeah.
So if the economic capital is less than the capital at risk, which means we have like part of the risk is exposed and having.
Well, your economic capital should always equal where that figure is equal to, right? But the reality is that your actual calculated ECAP may actually be lower than what that figure could be. Now, what I'm saying is that in a perfect world, you would expect that your capital at risk will always equal your economic capital, because it's measuring the same thing, right? And therefore what that's saying is that I've got equity capital, and I need to have equity capital when placing at risk, right, capital at risk, right, equal to whatever my ECAP is equal to. The reality is, though, that in some firms they might be better managers than others, and therefore they might have a lower ECAP than what the others might actually have.
If it has lower economic capital, so it may not have enough capital to against the.
Well, if you don't have enough capital, that's a different problem. If you don't have enough capital.
The question is like, what happens if there's difference between economic capital and capital risk? That's equal, so.
Okay. Okay. Well, no. Well, this is one of the quiz questions from this week, isn't it?
We have two solutions.
Yeah. No. I understand. Right. So they are measuring the same thing. Right, they're both measuring the same thing, okay? But it just could be that. But think about it another way. I could have some loans that I look at individually. Remember, this is trying to measure for the aggregate of the whole firm, all right? And when you aggregate the whole firm, there's the individual assets and other things that you're looking at and what their ECAP is. You've got all your market exposure, you've got all your credit exposures, all your other things that you're exposing the firm. And then what you want to do is then add all of those things up together, right? So therefore the ECAP is basically akin to saying that I've gone through and I've calculated VARs and I've calculated, right, a whole range of different parameters, and then when I've tried to add them all up, I've had to take account of the correlations between them as well to come up with what the total figure of the capital at risk will actually be. Well, doing the ECAP is exactly the same thing, because the economic capital should reflect the amount of capital that I have to hold in order to be able to actually cover those losses if they should occur. So that's hence they're the same thing. They end up being the same thing.
What is the difference?
But I'm saying they can't be different because it's not feasible for them to be different. Right? The difference would be that maybe they can be different. Let me think about it for a second. No, they can't be different because they cannot be different because the economic capital tells you the amount of capital that's needed to cover the risks. Right? Your actual capital, you're confusing actual capital, right? Your actual capital is different. So you've got, this is the amount of capital I need to cover the risks, right? And when I calculate what that is equal to, right, I can do some sort of bottom-up sort of build on that, or I can do some sort of top-down aggregation of it, but nonetheless, I can estimate what that figure is equal to. I can also, as one of the approaches, one of many approaches I could use an at-risk methodology. And if I use an at-risk methodology, then I would expect that the at-risk figure should be equal to what the ECAP figure will actually be, right? That has nothing to do with what your actual equity actually is. If your actual equity is different to that figure, then that's a different discussion, that's a different problem. Because if your actual equity is more, then that means you're underutilising for the risks that you're taking, right? And alternatively, if your equity figure is less relative to the risk, you've got a big problem, right? Because obviously the ratings agencies will probably have already picked that up and they'll be doing something about that anyway.
So it can't be the same thing, but different.
Same thing, different, well, and also different approach. I mean, I can measure expected loss. I can measure economic capital using a range of different approaches, including capital at risk. Yeah. So capital at risk is just one approach. Yeah. Hello.
I think I have a question.
Yeah.
But I just want to admit that so the economic capital really depends on the risk reference of managers, right?
Yes, that's correct.
Yeah, that's why I want to say.
That's right. But remember though that within the firm that managers and others, when they're making their decisions, are going to some are going to be really risk averse, some are going to be risk takers, and therefore we've got to get the balance right. So that the risk appetite of the firm is reflected then in the choices the firm is making about which projects they want to go ahead with.
Yeah. So because I just want to ask that based on the expected loss and unexpected loss, how can you calculate economic capital? I think that you have already answered based on the approach value.
Well, what I'm saying is that the way you can do it is you can either do that by aggregating the individual business units and looking at what their risk is, or alternatively you can look risk by risk by risk and work out what the expected and unexpected losses are for each different risk. Right? Most corporates tend to do it at a business level, right, rather than necessarily doing it at a micro level of every risk, because a lot of risk cut across the business. So, for example, if I'm a big firm, I could have foreign exchange risk that affects 90% of my business, but I could have 25 business units. Right? So if I looked at FX risk in isolation, right, that's going to have a different outcome to if I was then to look at it within the context of each business, where I might get netting and other things actually occurring.
So is the value at risk the same as capital at risk?
Yes, well, the capital at risk is a form of at-risk methodology.
Oh, okay.
Right? Remember we talked earlier in the last week and I said that you've got different types of at-risk. You've got the value at risk, you've got earnings at risk, you've got profit at risk, and capital at risk.
I just want to ask, so I mean you said about the booklet that about the equity minus the economic capital and total multiply the risk-free rate.
Yes.
So that is would be the income from capital, right? Or
No. This will be, right, you will have, let's say you've ascertained what your economic capital actually is, and then you've looked at what your value of equity actually is, okay? If there is a difference between those two, then what you do is you calculate what that difference is, and then you multiply that by the risk-free rate.
But what is the optimal?
Well, the optimal level is to have it equal. You should have your equity equal to what your actual risks actually are.
What will happen if we got the amount bigger
Well,
than...
chances are, if you're holding more equity than the risk is that you're capable of taking, right, the stock market will penalise you anyway, because the stock market would say, well, you could have taken more risk and therefore you chose not to, and therefore they'll say, well, we'll drop your share price until you actually do something about it.
If the company took too much risk,
If too much risk, they'll drop your share price as well, because you're obviously, you're pushing.
too risky.
It's too risky. You might end up defaulting, or you might get yourself into financial difficulty. Okay, that's good.
I just got a quick one. I was wondering, do you have you only come to school at Monday, so can I book appointment to answer questions? Or
You can.
Yeah, I was wondering what time are you free this week?
Okay, this week's going to be very hard for me to be available this week.
Because the exam is
I know, but you've got Natalie's available this afternoon. You always go and have a chat with her.
I was thinking I didn't finish it now, so...
Oh, okay.
Or is she Or
No. That's a fair question. Can I have a think about it? And
Yeah,
then
sure.
I'll put something up on the... I mean, you can always send me an email. Right? Send me an email.
I sent one to say, do you have... do that tutor have available
other times? Yeah, okay.
You
It was you that said that. All right. Because I just look at the name. I don't look at the pictures and the names, right? So,
Sorry.
no, that's okay. That's all right. That's
Sorry to
right.
cause the inconvenience.
There's no inconvenience. It's just I am here again on Thursday, but I'm only here for a very short time on Thursday.
So I think 30 minutes maybe is enough.
Okay. Can I have a think about that?
Yes,
Because
sure.
I just got to be
I can drop
careful.
you an email.
No, but please do. But I just got to be careful I don't overcommit myself, because I've got something else I've got to do later this week as well. And I just don't want to sort of give you. It's nice to give you 30 minutes, but at the same time,
Yeah, I know.
I might end up costing something else if I
Yeah,
do
I will
it.
drop you an email, then you can do it. Thank you.
All right, thanks. Oh no.
I
Yeah.
got one last question.
All right, have to be quick.
Really quick. So
Yeah.
I got access equity which is more than the equity I needed, economic capital.
Yep.
So which means here says so the access need to be deduct access at risk-free
Yeah,
rate.
yeah.
And here is plus the income from capital. So should I deduct it or plus it?
No. That's risk-free free rate. Capital exceeds the earnings, so you need to deduct excess. Deduct the excess.
So I got change cost.
Can you send me a question on that on the email, and I'll answer that in the email.
Okay.
All right? Because if I need to adjust that, I'll adjust it then, but I'm pretty certain that formula is right, which means that might not be worded as clearly as it could be.
Okay.
All right? Okay. Okay. Right, let's go, everybody. We're on again. All right, so what we've been doing over the last few weeks is looking at basically how do firms think about setting up their risk framework, how do firms think about risk processes in the sense of when they're trying to, identify, evaluate, assess, right, and all those sort of things. The bit of the puzzle we haven't looked at so far is how do firms actually manage their risks? What are the treatments that they put to those risks, and how do they, on an ongoing basis, actually monitor what is actually going on? Well, for the rest of the course, that's what the rest and balance of the course is about. What we're going to be doing is we're going to be looking at different types of risk. We're going to look at market risk, we're going to look at liquidity risk, we're going to look at credit risk, we're going to look at funding risk and so forth. So the risks that are the primary risks that a corporate treasurer is going to be exposed to. Sometimes we'll look at it through the lens of how a corporate might look at these things. Sometimes we'll flip that and we'll look at it how a bank might actually look at these same risks, okay? And sometimes there's some interesting differences that occur there as well, and we might flag a few of those as we go through as well. Then, of course, what we've got to do is by the time we get to the end of semester, I need to have made sure that you've got clear in your head, hopefully by then, as to how a risk framework actually operates within a firm, but also how it operates within the confines of what obviously a treasury manager is trying to do. Treasury manager is not responsible for all the risks of the firm, right? They are just responsible for the financial risks of the firm. And therefore, as a line manager, as a person who's responsible for those risks, whilst they need to be aware of what's happening in other parts of the firm, their primary focus and concern is just on that part of the firm's operations. All right, so what we want to do now is we want to move over the next couple of weeks to talking about market risk. And we're going to kick off this week by using commodity price risk as a mechanism, and then we'll move from commodity price risk into talking about, if you like, FX risk and interest rate risk that we'll probably do the week after the actual exam itself. Because you remember the exam itself is going to be on, obviously, in a few days' time, or next week. There's no class next week, right? Don't turn up here. Oh my gosh, no class, right? Obviously got the exam. And even after you do the exam, right, go and celebrate. Forget it. Just get it out of your head straight away. Go and do something else, okay? And then obviously I'll see you again back here in week 8, okay? I'm sure you'll all do okay in the exam. Normally the exam, the average is about 13, 14, thereabouts. So, I'm not, that's pretty good. That's 60, 65%. For a midterm, that's a pretty good sort of mark that you'd normally expect anyway, all right? You guys might exceed that this year. Who knows? You might do better, right? And who knows? You might even do better than the night class, or night class might do better than you guys do. I don't know. But you're all doing different exams as well, all right? So I've set it up that the night exam, guys, just so you know, the night exam is different to the day exam. Very different. I mean, similar sort of questions, but very different. That means if you have a friend in the night class, telling them what you just saw on the exam will not help them. All right? Or even by a process of elimination, go, well, that was in there, so it won't be on yours. That won't help them either. right? But sometimes we can cross over, but we can cross over with different questions about the same sort of topic areas, okay? All right, so I'm looking forward to obviously seeing how well you all do, because I'm looking around the room and I'm looking in and I can see lots of faces that I've seen here each week. So I do hope that you are actually successful with the midterm. All right, so I'm just going to kick off, and then I might just, given that you guys were talking so much to me during the break, I didn't get to have a break. In fact, why don't you guys just have a quick chat here to yourselves now for a minute, and I'll just go and have a quick break myself, if you know what I mean. I'll just be back in a minute, all right? Give me 2 minutes. 2 minutes. I'm just going to get a drink. Very good. Okay, I'm back. Oh, I feel better now. Serious. I ran into someone outside I knew. That was happy. All right, so there you go. Good. All right, so market risk. Wow. It is interesting, you know. Market risk is one of these areas within finance that a lot of people get very, very excited about because, you know, a lot of people aspire to be traders and they want to work in capital markets or they want to do this and that, trade derivatives or whatever it might be. But, you know, from a corporate perspective, market risk is basically something that is, yes, very important to corporates, but nowhere near as important as things like liquidity risk and funding and credit risk, as it turns out. Right? And even in banks themselves, that you think, well, banks, they're out there trying to actually, you know, trade all this stuff and make lots of money. But at the end of the day, banks are all about credit risk at the end of the day, really, when you think about it. It's just that they obviously trade as part of the activities that they do. So I'm not trying to downplay the importance of market risk, but I suppose what I'm trying to do is to sort of give it a sense of where it really sits in the real true order of all things. But it's probably also the area that within the different areas we're going to talk about is probably the most understood and also probably easiest to learn as well is market risk. Okay, so let's get our mind around it and see how we go. All right, so in terms of readings for this week, there is a book by a guy called Steve Allen, really good book on financial risk management. He talks about market and credit risk in his book, but I'm going to pull out 2 chapters in that book that I want you to have a look at. The first chapter is a chapter basically on managing spot price. The second is managing forward prices. when it comes to trading in financial markets or commodity markets or whatever they might be, we observe spot prices, which are prices that are current right now, and we also have prices that are obviously for future buying and selling, and those obviously reflect what we call forward prices, okay? So obviously at any point in time there is obviously a need to manage our exposure to spot price, in other words the price that we observe right now, and there is also a need to manage obviously what our exposure is to those forward markets as well, to the forward prices. So for example, if I wanted to purchase some sugar, I could go to the sugar markets and I could purchase that right now, and I would purchase 1,000 pounds of sugar in the sugar spot market. Or alternatively, what I could do is I could wait and I could purchase that 3 months from today. Now, when I purchase that sugar 3 months from today, the price 3 months from today will in fact be the spot price 3 months from today. Right? So obviously I could have bought it today. Alternatively, I could have left it and then in 3 months' time go and buy it in 3 months' time. In 3 months' time, so the time has elapsed, when I go to buy it on that day, that again will be the spot price on that day when I go to the market 3 months from today. If I go to the market 3 months after that, 6 months from today, again, that is the spot market. So the spot market keeps moving through time. Spot prices keep moving through time. Also, we know that of course what I could have done was I could have gone to a bank or to some other institution, or I could have negotiated through my bilateral contracting with other firms that I'm dealing with. I could have negotiated what is called a forward price. Now, a forward price implies that we agree a price today that will apply in the future. So that price that we agree that will apply in the future obviously should reflect something about what the current spot price is, but it should also reflect obviously the factors that are likely to change between now and when we do get to that future point in time. Because in an ideal world, what we would want to happen would be that the forward price will be equal to what that spot price will be in the future. Right? In other words, use my earlier example, we could have waited 3 months and then we'd be exposed to spot price in 3 months' time. Alternatively, I could have entered into a forward contract today for delivery in 3 months' time, which gives me the right to buy or sell whatever the contract was at that future point in time. And then what happens then, of course, is I've got to perform whatever it is I've agreed to do on that day. If the market has got it right, if the market is really good at predicting forward prices, then of course the forward price should be equal to the spot price on that future day. Unfortunately, markets are not really good at doing this, right? Why? Because things change, right? We're not in the business of crystal ball gazing. Markets do change. Markets are normally not too far away though. They're normally under normal operating conditions. They're normally in the ballpark. So you'll find the difference between obviously the actual spot price in the future relative to the actual forward price may in fact be, of course, slightly, should be equal to each other. They might just be marginally different from each other. Right? And a good example of that could be, I might contract to buy sugar at $9 a pound, and when we get to 3 months from today, the price might be $8.95, or it might be $9.10. Right? It's not likely the price will go to $55, right, over a period of 3 months, and it's not likely it's going to fall back to zero over that period of time. It's going to be roughly in the ballpark. And think about it another way. The distribution of possible price changes over 3 months, right? Where are most of the observations? They're going to be small observations that are going to be tight inside that inner part of the distribution, aren't they? One standard deviation covers 66% of all the observations of where the prices could move to, right? And over a 3 month period, right, that obviously could be a useful thing. If we were looking at a price change over 5 years though, well, we might say, well, hold on a minute, 5 years, that's a long time. There could be structural changes, there could be regulatory change, there could be any number of factors that might affect the industry, and therefore we don't expect that that's going to be a really good predictor at that point in time. So as you'll see later today, there are 3 prices at any point that I have to worry about. I have to worry about the spot price, I have to worry about the forward price, and I also have to worry about what is called the expected spot price. And the expected spot price, of course, is the price that reflects what my expectations are of what the spot price will be on the same day as obviously where the forward price will actually occur. And of course, in each of those cases, I'm forming those expectations obviously all at the same time as to whether or not the forward price is a good price or not, what the expected spot price is likely to be relative to the forward price, and also whether or not I think today's spot price is a fair price or not as well. So what are the things that I want you to be able to do? Well, firstly, I need you to make sure you can explain the concept of market risk. What is it when we talk about market risk? What is it that we're actually talking about? Okay, I want you to be able to, and we want to look at market risk in a couple of different guises. I want you to be able to differentiate between spot and forward markets. And then we're then going to get into looking at these relationships between spot, expected spot and forward markets. And to do that, we're going to introduce some concepts, contango, contango, and also backwardation. All right? So we're going to have obviously some concepts that we're going to have to deal with there, and you're going to find we've got contango, backwardation, and we have a thing called normal contango and normal backwardation, right? And we don't have any abnormal contangos or anything like that, so we don't have to worry about that. And then finally, I want to introduce to you the concept of what is called cost of carry. Now, some of you are doing derivatives and other units probably have already done some work on some of the things I'm going to talk about today, but I'm going to be talking about this from the perspective of obviously a corporate treasurer trying to deal with these things rather than just the mechanics of the calculation itself. All right, so what is market risk? Well, remember, we've defined risk for our purposes in this course as being about the effect of uncertainty on what our objectives are. Right? We've defined risk more generally as reflecting the ISO definition of being, of course, as I said, that risk is about the effect of uncertainty on our objectives. So if our objective is that we want to purchase a particular quantity of something, whether it be FX, interest rate, or alternatively, if we want to purchase some commodities, there is going to be price risk associated with what those different attributes are likely to be. So when it comes to defining market risk, we'll take market risk as being, by definition, as being the risk of financial loss that results from movements in market prices. So what is the uncertainty part? Well, the uncertainty part, of course, is the fact that there is a time dimension between now and when obviously you might need to purchase or sell the commodities or whatever else it is you're doing. But the other effect in there as well is that generates the uncertainty is that because, especially in forward markets and expected spot markets, we can't observe directly what those prices are going to be. In other words, we don't know whether those prices will actually achieve the perfect outcome that we hope that they will. So, in other words, as a corporate treasurer, we need to be able to obviously balance out whether or not, if we were unhedged, would we be likely to make a bigger loss than if we were actually hedged? Is there a possibility that by hedging we might forego some of the potential gain that we might have got if we were actually unhedged? Okay? So therefore, hedging is not always about, obviously at the end of the day, hedging is not about just simply trying to eliminate risk. We know it's not that. It's trying to minimise risk, but what it's trying to do is to minimise risk in such a way that you are still able to achieve what your objectives actually are. All right, so the different types that we might be exposed to: commodity, interest rate, FX, and equity price risk. The equity price risk here is not your own firm's equity price risk. It is the equity price risk that arises when you actually have a joint venture. So if you are a firm that has basically got lots of JVs or you've got equity ownership in subsidiaries, then of course there are equity price risks associated with the price and value of obviously all of those different ventures and subsidiaries. And therefore again you're going to be exposed to any changes that happen there. So let's assume I'm a big coal mining company and I set up a project, and in the project, that project is a JV with another company overseas. Then of course I still have to manage the risk, not just associated with the commodity price, but also associated with obviously the value of that equity, because the value of that equity will be consolidated into my balance sheet, but also the value of any dividends will become a revenue source for my firm as well, and therefore my risk is that, of course, if that firm fails, that of course then I'm not going to get those dividends, and I also won't get the return on equity that I otherwise thought I might. Okay, next one. Okay, so we need to make sure that when we basically talk about, if you like, market risk, that we are really sure as to where the market risk is actually coming from. Does the market risk come as a result of transactions that we are actually undertaking? So in other words, if I'm buying or selling commodities, if I am investing in interest rate products, if I am borrowing, if I have to do foreign exchange transactions, does the risk come about because of the transactions that I'm undertaking? Does the risk come about because of, obviously, the fact that I've got a balance sheet that I've got to manage? Is it possible that, obviously, with a change of interest rates changes the value of what my market value of my investments and my borrowings are, therefore a change in the value of my assets and liabilities, which therefore might affect what the value of my equity might actually be? Alternatively, what if you had foreign exchange exposure whereby I've obviously got, let's say, subsidiaries operating overseas, and I need to consolidate those subsidiaries into my balance sheet? Right? That's a form of what we call translational exposure. That's a balance sheet exposure that is nothing to do with transactions that I'm doing day to day. It's just at the end of the financial period, I've got to bring it all together. I've got to consolidate everything back in again to work out what its value will be. And then finally, we get what are called economic risks, and economic risks typically come about because of the impact of economic factors and how those economic factors then might change the nature of foreign exchange, interest rates, commodity prices, etc., etc. Some of that could be driven off the back of just boom and bust periods, recession and growth periods. Some of it could be driven off the back of inflation. Some of it could be driven off the back of changes in variables leading to things like unemployment and other factors that might actually be good explanatory variables of what's happening within a firm. So it's really important, therefore, that when a firm sits down to work out what its market risk exposures are, firstly, that it understands where the sources of the things might be, but also needs to understand the different types of exposure that they might actually be confronted with and where these exposures might emerge within the firm. And that's going to be important because by virtue of where they emerge might also affect how you might choose to manage them as well. Right? So it's not just like one size fits all. We're going to hedge all foreign exchange transactions over $50 million. Right? That might not necessarily be the case. We might have to have a policy that's a little bit more robust than that. So what you'll find is that obviously the way that the firm will view the market risk is already have been assessed as part of the risk appetite of the firm, part of their risk framework we talked about a couple of weeks ago, and also obviously by virtue of thinking about what the firm's risk appetite is, what are the limits that the tolerance levels the firm's willing to accept for exposure to these different commodities, FX, interest rates and so forth, and then finally, of course, trying to understand all of that, how it gets communicated downwards, obviously, through policy and procedures that the Treasurer then has to implement as a line manager within the firm. So as a result, you see that, of course, these factors are going to have a big impact on how market risk is obviously treated within the firm. As a process, well, what we know, of course, is that whether it's market risk, all the different types of market risk, we know that, of course, we need to be able to clearly identify what are the different types of risks that we're actually going to be exposed to. We need to be able to assess those risks. We need to be able to understand in terms of the severity of their impact as to the degree of what their impact is actually going to be and the frequency of the impact as well. If it's a one-off thing, then we might not need to worry about it, because if it's not recurrent, then it might have a one-off effect, could be small. We might choose to do nothing about that, right? And therefore the way we choose to do treatment and so forth will be affected by that. And then we might set up, through an evaluation process, a range of possibilities as to what the behaviours might actually be. And this is where some of the things that I've taught you over the last couple of weeks, things like looking at things like economic capital, by looking at RAROC, by looking at the VAR, by looking at sensitivity analysis, scenario analysis, stress testing, looking at early warning signals. This is where all those things come in, is by actually looking at all of those things as part of your assessment and evaluation. Once you've done all of that, you then work out, well, of course, subject to what the policy requirements are, what is the appropriate risk response that you want to put in place. In other words, then that might involve hedging, not hedging, or it might involve having to transfer the risk in some other method. If you do all of those things, of course, then you then have to obviously assess what your performance has been, and as part of doing that, of course, you would do risk reporting. You would report relative to your limits, but you would also be reporting upon, obviously, what the actual remaining exposures actually are, so it's very clear to the board as to just how much risk the firm is taking on at any point in time. So in order to do all of these things, of course, that requires a nice feedback loop, which includes communication, and you can see that this is like, we don't just sort of like do one thing and then steps, and then feedback, next one, feedback. You're going to be doing lots of these things simultaneously, and sometimes the decisions you make here might affect outcomes that might affect something over here as well, all right? So if you're a really big player, for example, in the foreign exchange market, you might find that your trading might actually be starting to influence not just FX, but it might also start to influence the interest rates as well. Right, because there's actually a relationship that exists between the spot price, the forward price, and the interest rates of both Australia and the other economy, right, to actually determine what the forward price might actually be. So if I'm a big FX player, who knows, I might actually start to influence as to where the exchange rate might actually start to move. Hopefully I won't, because I mean there's only a few firms in Australia that are capable of doing that, but normally most places will be price takers at the end of the day. But for banks see themselves as price makers, so they're going to be very keen to obviously see where they can make a dollar. We know that, of course, firms obviously are going to be confronted with lots of complexity in terms of market risk, and this is why that whole framework stuff that we talked about back in week 3 is just so important. We've got to understand that risk framework and how that then applies, obviously, to the market risk. And, of course, the risk framework stuff, you remember, is all about having your risk principles, the risk framework, and then the risk processes. And then having all of those structurally laid out that everyone's fully informed, there's a good risk culture within the firm, and then of course we can then start to obviously get the best possible outcomes if we do that. Firms have to make choices with regard to their risk response, how they choose to actually respond to the risks that they're going to be exposed to. As part of doing that, firms will make decisions as part of their risk appetite and setting up of the risk itself as to whether they choose to avoid the risk, whether they choose to accept the risk and retain it, in other words, to do nothing about it at all, or to reduce the risk, possibly by maybe using better internal controls, diversification, or alternatively through other non-derivative type approaches like netting and matching of cash flows and so forth. And then finally, they might choose to transfer the risk, and by transferring the risk, that's when they might then choose to obviously use derivatives or to go into long-term bilateral contracts or other contracts to facilitate that. But you know, even within the different types and categories, whether we're talking about FX, interest rates or commodities, there are also subcategories of risks that sit within those different aspects as well. So for example, as I said earlier, if I was looking at currency risk, I'd be interested in obviously the transaction exposures, I'd be interested in translation exposures, and I'd be interested in economic exposures. Right? I'd also be interested in things like obviously long-term versus short-term exposure, the intercompany versus third-party exposure, intra-company I should say, versus third-party exposure. So in other words, what exposures have I got internally within the company, where I might be able to do matching and netting and other things to manage that. And then also what third-party exposures have I got, where I'm transacting with other parties, and that in itself generates obviously a currency outcome for me. I'll also be interested in making sure I've got a good understanding of obviously what my cross-currency exposures are. In other words, I don't just simply trade US dollars. I could be a firm that has basically got some manufacturing happening in let's say, Thailand, and at the same time I might have another stage of manufacturing happening in, let's say, Hong Kong. Well, there I might be an Australian-based company, but I'm going to be exposed to obviously moving goods between Thailand and Hong Kong, which means that I need to understand the dynamics of the Thai baht exchange rate relative to obviously the Hong Kong dollar exchange rate. And because when we start to look at these cross-currency exposures, we start to see that there's some very strong underlying historical correlations that exist there that we need to take account of. And of course I need to be aware of obviously any other exposures that come about through the fact of competitors. I might be a firm that has no FX exposure directly, but all my competitors are importers. Therefore I do have a currency exposure. It's what we call a competitive exposure that comes about indirectly because your competitors, if the Australian dollar for example was to appreciate strongly, that would mean that they can import for cheaper prices than I can manufacture in Australia. Therefore they'll sell more goods than what I can sell in Australia as a result of that. So obviously whilst I don't have a direct exposure to the exchange rate, the indirect exposure comes through obviously who my competitors are and what they're capable of doing. When we go into areas like commodity, well, we've got price risk, basis risk, correlation risks. Again, transactional, there are some translation exposures on that, and there are also some economic exposures that will apply in here as well. I've got problems that come about due to commodity prices affecting procurement, affecting inventory, and also affecting the elasticity, the price responsiveness of what my sales will actually be. If I was to have an increase in the price of commodities that affect the manufacturing process that I use, I have to assess, am I able to actually pass on that increase in price? So in other words, the commodity price goes up, therefore I'm using that as an input to production. Can I actually pass that on to the actual sales team? And the sales team then pass it on to the customers of the firm. Right? And it could be that I might not be able to because I might already be contracted, or the competition in that market could be so large that obviously the ability to pass through those price increases obviously becomes very difficult to do. Therefore that might affect then what my judgment might be as to whether or not I choose to actually hedge those exposures. Right? Because then I'd probably be more risk averse if I know that I can't get that sort of pass-through outcome. But if I operate in an industry where basically every time the price goes up, I can pass it through, and every time the price goes down, I can just maintain it at basically roughly the same level of where it is right now, then obviously I don't have as much competition. Right? And under those circumstances, of course, then I would be looking to exercise that to generate super profits, obviously, from what I try and do. And therefore my propensity to want to hedge might be minimised, because I might say, well, you know, what's the point of hedging? Because obviously I can pass through the price increases anyway, and obviously if the price goes down, well, that's going to make me make more profit. So I'm not going to hedge that and give up that obviously profit that I might otherwise make. So can you see that you've got to have a really clear understanding of obviously the company, the industry within which the company operates, and also ultimately, of course, the environment or the economies that the company is going to be exposed to. All of these things are very likely to affect what your market risk exposures may actually be. All right, so we'll talk about interest rate risk in itself next week, because that's or week 8, I should say. Is when we'll talk about that. Now, one way, and I have talked about this before, but I thought I'll put it into a slide so you can see what I was talking about. One way that I can actually assess as to whether or not the returns to equity holders are going to be affected by changes in variables is to actually try and set up basically an econometrician's magic trick of running a regression. All right, what I can do is, right, I can simply say, well, look, if I get the return on equity, right, and then I express the current return on equity as a function of alpha plus beta multiplied by the return on equity at time t minus 1, in other words, just in the last time period, okay? So it's akin to saying, look at what the change in price is today relative to the change in price yesterday. And the reason why you do that, it's an econometrician's trick of basically making sure that you actually end up with the right outcomes in terms of what's called the stationarity of your data. In other words, your data has got appropriate qualities that we can use. You don't need to worry about the econometrics here, right? But essentially this is a variable that you should always put in when you're using the return, right? And then to that, we then set up a range of factors. And the range of factors from 0 to n in factors will be that we'll multiply the beta j, right, which is different to beta I obviously, beta j multiplied by x, where x is, for example, the return on short-term interest rates, the return on foreign exchange rates that you're exposed to, the return on commodity prices that you might be exposed to. Okay, can you see where I'm going with this? And then maybe even the return on equity for investments that you've actually got. And by doing this, what you're looking for is that if any of those beta J's become significant, in other words, if you look at those and the coefficients are statistically significant, right, then that means that that particular variable does have explanatory power. In other words, your company, if you think your company is heavily exposed to the price of iron ore, then what you do is you'd put your return on equity is a function of the prior return on equity from the prior period, right? Plus to that, you would then have the return on the changes in price of iron ore, right? And the idea being that if your company is exposed and equity holders are exposed to the change in iron ore prices, then of course that would become a significant variable. It would become an explanatory variable. What happens oftentimes though is that when people do this sort of analysis, and it's a first step, if you like, into understanding, well, where are our true risks located, okay? You need to do it in a way that assumes, firstly, that the firm is not hedged. Because if you do it assuming the firm is hedged, then chances are your explanatory variables, like iron ore price, for example, are not going to be significant. Because if I'm already hedging the exposure to iron ore, then why should changes in the price of iron ore affect what my return on equity is actually going to be? Yeah? Whereas if I'm not hedging iron ore, then I might find that, gee, yeah, maybe I do actually have a correlation here that's important, and therefore the beta coefficient again may actually be significant. And this is important because, for example, if I wanted to understand, I've done a lot of borrowing as a firm, and I want to understand what the impact is on the return on equity of a lot of borrowing that I've undertaken, and therefore high levels of interest rate risk exposure. I might put the actual dollar value of the change in what the interest rates would be and see what the impact of change of interest rates are on, obviously, the impact over here in terms of return on equity. But by simply loading that in as basically the change from 14% to 14.01%, really is not that informative. What you're better off to do is to price it and put prices in, because prices are more informative about returns than actual basis points are. So, and because then we've got our little E on the end here, because we're doing an econometric model, so we've got to have our little E thing on the end here, because it reflects any residual sort of errors and so forth that would be incorporated into the model. Now, this approach here allows you to assess a firm with regard to the firm's returns and their covariance to a range of different macro or external variables. You could also look at some internal variables as well if you wanted to. So you could look at things like, you know, change in accounts receivable, or change in accounts payable, or anything like that. But the trouble is, when you use that data that's firm data, you can only measure that about once a month or once a quarter or once every half year. So you'd have to have a time series to make this worthwhile. You'd have a time series over a long period of time, and therefore that's really not that instructive. However, what I can do is, if I can get monthly prices, I could just look at the last 5 years, right? 512, 60 observations. Statistically, it'll just be there in terms of robustness, but 60, 72, 84, 96, but as I increase the number of years, I get more and more observations. If I can get daily prices, that's informative as well, right? But I always worry about daily because chances are in daily markets, there's a lot of other factors that, like in terms of traders' behaviours, that are likely to influence what the outcomes are going to be. All right. So when firms formulate what their response is, when firms formulate what their response is going to be to a change, if you like, in the any variables, and then therefore you remember that, of course, we identify, assess, evaluate, and then we treat the risk, right? We do have a risk response. And the standard risk response that most people jump to straight away, oh, we've got to hedge the risk, right? Well, you're going to fully hedge it, partially hedge it, micro hedge it right down to the little bit. Are you going to aggregate all of your risks, and you're going to hedge both your buy side and your sell side, or are you going to hedge one side, the buy side or the sell side? Or are you going to net your exposures and then just hedge your net exposure at the end of the day? Right? Each of these different conundrums, if you like, need to be considered as part of what the hedging decision might actually be. But of course, when we do hedge, what we're really trying to do, of course, is we're trying to minimise what our exposure is to unwanted financial risk. And by trying to do that, of course, the idea is that we want to do this as a way of trying to, as I've highlighted down the bottom, obviously to minimise the risk that we are exposed to. That's the only reason why we engage in hedging. We don't engage in hedging to try and generate profit. That's called speculating. All right? So if you are exposed to a price decrease, right, and then what you do is you take a position that is consistent with maximising the returns to you if the price does decrease, then you're actually speculating. All right? That's obviously not a hedging strategy at all, because the outcome of that, of course, is that you're actually creating a situation that's actually worse for you than what it might otherwise be. All right, so if you are going to hedge, here's a few ideas. This is actually from a paper that was put together by a really good friend of mine that works at Deloitte, okay, and his paper basically said, well, look, when you're considering to implement a hedging strategy, remember this is going to be part of the risk appetite, the policy framework that the firm has set up, right? Well, what he'll say is, he says, well, the hedge strategy should align with the overall corporate strategy, duh. The hedge strategy should be congruent with the board's risk appetite, duh. Right? The hedge policy, the policy document should be approved by the board and needs to be continually monitored, another duh. Right? And then, of course, then he starts to get into a couple of things that I think actually are of value to us. Firstly, right, that the notion that very few individuals can accurately predict the movement of commodity FX and interest rates. Right? There's an element of dirt to that as well, but at the same time, it's a very valid point. And because we can't predict, therefore you are probably more likely, if you are risk averse, to go towards the idea that you will actually hedge what your exposures are. And also, once you've implemented and put in place what your hedging strategy is, I can't, for example, as a board, give you a policy framework with a hedging policy in it that then says, oh, we'll review this in a month's time, or we'll review it in 3 weeks' time. Right? It's got to pass the test of time. So in other words, it's got to be robust enough as a technique, right, the techniques that you allow, that actually allow for flexibility, that allow for the treasurer to be able to implement the requirements of what the board want, but at the same time gives flexibility to the treasurer, that the treasurer is then not locking in decisions that will be very bad for the firm at the same time, just because obviously the firm has dictated that it wants to be hedged in a particular way. Now, the best way to think about this is this. When you deal with foreign exchange, commodity prices, and to a certain extent with equity, what you find is that oftentimes the size or proportion that needs to be hedged will be a function of the size of the exposure. If you have really small exposures, let's say under $1 million, the firm might say, don't need to hedge those, right? If you have exposures that are between, say, $1 million and $10 million, yeah, they've got to be exposed, but you've only got to hedge 50% of those. When they are greater than $20 million or $10 million, the firm might say, well then, as a treasurer, you've got a choice. You can either hedge 50% or anywhere up to a maximum, normally it's set at about 75 to 80%. All right? And the reason being is because we don't want you to be 100% hedged. To be 100% hedged can actually create a loss in value to the firm. And the reason being, because if I'm 100% hedged, what I've done is I've actually locked in all of the price. And therefore, if the price does move in our favour, I'm going to be stuck with having to buy at whatever that agreed price actually was. And of course, if that's a long-dated contract, that means I'm stuck at a fixed price all the way across time. Right? And you remember I spoke to you about Mattel-Gesellschaft a few weeks ago, and I talked about a German company that what they did was that the sales team went out and they locked in the sales prices of contracts for gas over a period of about 5 years or more. But the actual Treasury team that had to hedge the gas prices, they could only hedge out to about 18 months. And as a result, that meant that as the price continued to go up and up and up, the contracts that they were using to do the hedging started to actually get above where the sales team had locked in all the revenue. As a result, of course, the company then wasn't able to obviously meet all of its requirements with regard to funding, and as a result, obviously had to go into liquidation. Luckily, the company survived, but nonetheless, obviously, it's still a story of time, that one. Now, when I do actually engage in hedging, I have to make decisions about the level of hedging that I propose to use. And this could mean that I might choose as a firm to be unhedged. Right? I might choose to have no hedging whatsoever. Right? And if I have no hedging, that means I'm fully exposed to whatever the market itself obviously is. Alternatively, I might choose to be selectively hedged. Selective hedging would suggest that I'm selecting which types of exposure I do want to hedge versus those that I don't. Also, selective hedging allows me to think about what is going to be the level of hedging that I might put in place. I might apply that 50% rule or the 50 to 75% rule, okay? And then again, I'm going to have flexibility within 50 to 75% as to just how much I do actually hedge. Did you notice that I didn't say anything about interest rate hedging? And normally you find with interest rate hedging, there are two sort of camps in terms of interest rate hedging. One camp is that long-term debt and long-term interest exposure to floating rates should be hedged 100%. And this is why you find that firms oftentimes, when they issue debt, they'll have to issue debt as floating rate debt to get it away. But what happens is then they will hedge that interest rate exposure by using something like an interest rate swap, right? And we'll talk a bit more about interest rate swaps and everything next week. Alternatively, short-term exposures. Well, let's say, for example, I want to raise a 90-day bank accepted bill in 90 days' time. That means I'm going to borrow in 90 days' time by issuing a security that's going to be accepted by a bank and stamped by a bank to say that they'll honour it if I default. And then what happens is, of course, that I have to repay that borrowing 90 days after that. So I repay the borrowing in 180 days. Because of the nature of that instrument, I've got an interest rate exposure 90 days from today. Some firms will choose to hedge that exposure, right? They might use a contract called a forward rate agreement. They might even use futures contracts to actually hedge that exposure, right? But what you find is the majority of firms don't hedge it. And the reason they don't hedge it is because they've often also got lots of investments, and those investments also are generating interest income. And so therefore, by virtue of having the interest income, if interest rates go up, the interest income also presumably goes up, because as they reinvest on their investments, that interest rate is rising at the same time that the actual short-term borrowing costs are actually rising as well. Okay? So some firms will basically look at it on a net basis and say, well, if I'm happy that the net basis is actually not that large, I might choose not to hedge in the short term. But certainly with the long term, they're more likely to obviously hedge the long term. So firms will choose to selectively hedge, either in terms of type or alternatively the volume of hedging they'll do, or alternatively firms might choose to fully hedge what their exposures actually are. And if I choose to fully hedge my exposures, of course, by fully hedging the exposures, that means that I am 100% hedged in everything that I do. Whether it's to spend $50,000 to go and buy a photocopier or whatever else, if that generates an exposure to FX, I will hedge that exposure. I might pool that with some other FX exposure, but I will still do my best to hedge that. And then that opens up the door to another form of hedging. Sometimes that people think is, I've got a great idea, let's over-hedge. My goodness. Over-hedging is a concept whereby if I'm fully hedged, I'm 100% hedged, right? In other words, I have a perfect offset, right? If the price goes up, the hedge compensates me for the fact the price has gone up, and obviously I end up at the agreed forward price. Alternatively though, if I over-hedge, what happens is that if the price goes up, right, then I've hedged to 100%, but then what happens is that my spot price has still moved up, but only to the volume that I've hedged, but then the contract that I've used for hedging is still actually generating value. Because let's say I've hedged, I'll start again. Let's assume that I need to purchase 1,000 pounds of sugar at $10, all right? And therefore, what I do is I enter into a hedge contract to hedge that price at $10. That's a 100% hedge. 1,000 pounds hedged at $10, I'm perfectly hedged. I've got a full hedge. Then what happens is I decide, well, what I'm going to do is I'll still have my 1,000 pounds at $10, but what I'll do is I'll actually overhedge, which means what I'll do is I'll actually put in 150. So I'll put in 1,500 pounds worth of sugar as the hedging instrument, which means that I have 500 pounds of sugar that is actually still at $10 a pound, but is now fully exposed to obviously where the value of that forward contract could go to. And as a result, what could happen is that if the price in the market then subsequently, instead of going up, the price actually falls, then what will happen will be that that overhedge will actually cost me money. So I can actually lose money by actually overhedging. Some people think they're really smart and they know the direction of where markets are going, okay? Well, I always say to those people, well, let's go to the casino and see how well you go at the casino as well, all right? Because if you know which direction the dice are going, then let's all play on the dice. So they're going to be unders or overs, right, in terms of what the outcome will be.
Part of speculate.
It's speculating. If you overhedge, you are actually speculating, but you are speculating to the amount that you are actually overhedged. Right? You're actually overhedged, you're speculating the amount you're overhedged. Now, there is one situation where you can overhedge. Ooh, sounds interesting. All right, one situation, and that is in the commodity markets and sometimes in the interest rate markets, you might not be able to get a perfect hedge. Let me give you an example. Let's assume that I wanted to hedge some rare minerals. Right? So I want to hedge rare minerals. But to hedge rare minerals, there is no rare minerals futures contract, rare minerals forward contract. So what I might choose to do is I might realise that there is actually a relationship between the price of rare minerals to the price of, let's say, gold. So I might use gold as a cross hedge to hedge what I've actually got in rare minerals. And in doing that, I might end up having to hedge 120% of the gold price in order to cover 100% of the rare earth price. Right? In other words, because of the value of the gold contracts relative to the rare earth contracts, I might have to overhedge using gold contracts in order to compensate for what the value of those contracts is actually equal to. In that case, even though it is technically overhedging, what you're actually doing is you're actually still fully hedging. Because what you've actually done is you've worked out the correlation that exists, the covariance that exists between those two markets, and all you've done is just readjust what your hedge ratio is. Instead of being 1 for 1, it might be a 1.2 to 1 hedge that you've got to implement. It'll also come up, I used to do a lot of work with various commodity people when I was at EY as well, and we used to often find that you go to places like with the cotton farmers. Cotton has something like about 16 different grades of cotton, right? There's something like about 16 different grades of cotton, from really coarse, ugly, fly-infested, yucky-looking cotton stuff, right up to the most purest, finest cotton you can think about. And what happens is that for the guys that are trading cotton, there is only one contract that they can actually use, which is, I think, the number 8 contract for cotton, as the hedge vehicle that they have to use. As a result, that means that when they're trading something like the really dirty, ugly stuff, like, for example, the grade 16 stuff, that what happens is then that obviously the value of that's really small relative to what the value would be of a number 8 contract. Also, if you go the other way, if you had, let's say, a number 1 cotton contract, the really super fine stuff, that's worth a lot of money relative to the number 8 contract, so again, you'd have to adjust for what that hedging difference will actually be. We'll talk a little bit more about hedge ratios next week, but let's just for now just keep moving forward, keep moving where we're going. So here's a little quick example just to highlight what I'm talking about, all right? Let's assume that you're the treasurer of a gold mining company with expectations of producing 3,600 ounces of gold per annum, equal production over each quarter. Assume that you've got a fixed rate contract with the Perth Mint that allows you to sell production to the Mint at a rate of $1,335 per ounce of gold that you're obviously producing. All right, so you're going to produce 36,000 ounces a year, which is going to be divided equally across the quarters. So that's 4 quarters, 36,000. Right, that's going to be 900 ounces per quarter that you'll obviously generate. And you're going to sell that at the rate of 1335 under a contract that you've got with the Perth Mint. So in the first quarter, right, the value of obviously your contract will be, prices are fixed at 1335 by 900 ounces. The value of your contract is $1.2 million. Alternatively, in the second quarter, obviously again, right, 90 by 1335, then 900 by 1335, and then 900 by 1335. All up meaning that, of course, if you had taken the 3,600 ounces and multiplied it by the 1335, you would have ended up at $4.8 million. Now, let's assume instead of basically having that fixed rate contract, what if prices had have actually increased over the year? If prices had have gone from current price of 1335 at the end of the first quarter to 1375 to 1400 to 1425 by the time you get to the end of the year. So what happens now is, of course, it'd be 900 multiplied by each of these prices to give us a price outcome. Notice that the prices, because the price is increasing, the volume is the same, 900, but because the price is increasing, therefore the actual value of these sales are obviously increasing as well. Total value of the sales now obviously almost $100,000 or nearly $200,000 higher than where it was previously. Alternatively, let's assume that the price decreases. Right, so it goes from 1335 to 1300 to 1275 to 1250. Well, again, if I multiply each of those by 900 in each quarter, we end up with a total of 4.644. Now, I've set this up pretty crudely by just basically assuming if the price goes up, the price goes down. We could have got more scientific with it. What we could have done was done a distribution of possible price changes, looked at historical price changes and seen just how far could the prices have potentially have gone on a quarter by quarter basis, okay? And maybe used the standard deviation and moved it by 1 standard deviation over a period of a year or something to see what the impact would be. A little bit more classy perhaps. Okay, so let's assume that I decided we're not going to hedge, right? Let's assume I decided we are not going to hedge. And if we decided we're not going to hedge, then ultimately my increase, right, my net position is going to be the original position that we obviously said. My original position, if I don't hedge, if there's no hedge at all, is going to be, I could have expected to get 4.806, right, $4.806 million. But if the prices had have increased with no hedging, I could have got 4.9. Alternatively, I could have got, obviously, 4.644. All right, so this is just giving me my different outcomes up and down. What happens if I had have hedged 25% of the outcome? 25%. That means 25% is locked in at the price from the Perth Mint, but 75% is then exposed to the market. Right, so if the price goes up, 75% goes up. If the price goes down, 75% goes down. Alternatively, if I was 50% hedged or 75% hedged, you can see that obviously 50% hedge means 50% is locked in at the Perth hedge price, the other 50% subject to whether the market is moving up or down. If I'm 75%, then I'm locked in 75%, and then I'm exposed to the price moving up or the price moving down. And then, of course, if I'm fully hedged, well, of course, then there is no change because I'm 100% locked into the Perth hedge price. So here we've got, with 25% hedging, what we notice is that the price, obviously, for an upward movement is actually quite a good price relative to what our hedge value would be at 4.806. But I'm only 25% hedged, and the other possibility is that the price could have fell, which means I end up at $4.6 million instead. If I was 75% hedged, I get some benefit on the upside, albeit only about $50 million worth, but I also could lose. But when I lose, I only lose probably about $40 million worth in terms of the loss that's going to occur. All right? And of course, if I was fully hedged, I wouldn't lose anything at all. The biggest problem I've got here, though, is that if I fully hedge myself, I've actually entered into a contract that does what? The contract I've entered into is to supply 3,600 ounces of gold. So if I don't supply that quantity, right, even though the price is locked in, if I undersupply, I'm going to have a problem, right? Because obviously I'm undersupplying, I've then got to go to the market and actually buy from the market to make up the difference to what my contract will be. And when I go to the market to make up the difference, what's going to happen is I'm going to have to buy at the market price to make up that difference, all right? So therefore you are always exposed with commodities to both price risk and what we also call volumetric risk, volume risk, because there is always the possibility that you might not be able to achieve the volume that you're actually trying to hedge yourself against, which is yet again another reason why firms don't like to 100% hedge their commodity exposures, because it gives them a little buffer in case they do suffer an instance of volume risk. I think I told you previously about the electricity generator down in the valley here, right? That basically shut down one of its generators to do maintenance. I think I told you this story before. Shut down one of its generators to do maintenance, reorganised all its hedge contracts based on that one generator being out, and then about 2 weeks later one of its other generators broke down. And so it was actually effectively over-hedged for all of its different exposures that it actually had. Because what it did was it didn't adjust. It previously was running at about 80% hedged, and then when the other generators shut down, they forgot to readjust the hedges back again to take account that they now had 20% of their volume of electricity was now not being generated. And so they were 100% hedged for 80% of what their production actually was if they had been producing 100%. Because they weren't producing 100% now, they were producing less. So we can actually see what the differences are by virtue of price outcomes on a post-hedge basis. So we can actually assess the value of the hedges. So can you see that if I wanted to do an assessment of what my exposures are, I can do things like sensitivity analysis, stress testing, scenario analysis, VAR and all those things, or I can just as easily put it into something like this, right, which then tells me as to, well, if I want to make a decision now about, you know, do I want to be hedged or not hedged, okay, by actually comparing what the difference is between having no hedged versus being fully hedged, I can actually see that by being fully hedged and prices go down, I'm $162,000 better off over the period of a year. If prices go up, I'm $175,000 worse off, but you know, from the point of view of a risk manager and also a board who is risk averse, they've got to ask themselves, do I want to be $162,000 worse off? And if the answer to that is no, then you need to hedge as much as possible. Alternatively, you've got to ask the board, would you be willing to give up $175,000 on an $8 million deal? And if the answer to that is no, then again you might have to do a variance. You might have to say, well, instead of hedging 100%, this is what happens when you hedge 75, this is what happens when you hedge 50, this is what happens when you hedge 25%. And then the board can start to make some informed decisions as to what level of hedging they do actually want to apply relative to obviously what the spot price will be. Okay? And it's very informative to do this because you can set it up, and I've actually done this a few times with different boards. Then you go in and you put it all up in the charts, and then you basically, what you're trying to do is to get their sense of, you know, because the way I normally used to do it was I'd go in and I'd show them all the price downs. Right? And they all go, oh, we can't afford to be, you know, we've got to be fully hedged, we can't afford to lose $162,000. And then I'll say, well, okay, that's great, but then what happens then if you are hedged at that and the price actually goes in your favour? What, are you prepared to give up $175,000? Oh, no, we can't give up $175,000. That's profit, you know, it's money for the shareholders. We can't give up $175,000. And then you can have a good discussion about risk aversion and obviously walk through as to what the different outcomes would actually be. And eventually you find that little sweet spot where obviously the board then says, yeah, that's roughly about where we think we'd want to, we'd be willing to lose that to give up that sort of upside, right? And by doing that, the board can then make a much more informed decision about what they think the benefits of hedging will actually be. Okay, that's good. All right, so let's keep going. The next section is, I just want to talk briefly about the relationships that exist between, as we talked about at the beginning, spot, expected spot and forward prices. Now this actually applies whether we are talking about interest rates, FX, commodity prices, equity prices, it doesn't matter, right? This same logic will always apply to all of these. All right, so let's go. Oh, that's a nice little diagram, isn't it? All right, now, this diagram we're going to talk about. Okay, we're going to do a few things on this diagram. On this diagram, you'll notice there's a couple of things. Two-dimensional space, we've got time on the horizontal and price on the vertical. Okay, time on horizontal, price on the vertical. Starts at time equals 0. So today, let's assume that we all agree this is what the spot price actually is. Spot price is today, might be a spot price in relation to, let's say, commodity price, sugar selling for £1,000 at $9.50 a pound. All right, we all agree that's exactly what the spot price will be. Over time, what could happen will be that the price could evolve in a number of different ways. Right, over time, and this could be a time period of a month, it could be a year, it could be 2 years, right, just over time. And what happens is the price might go up. Price could go up, right? And if the price goes up, that means the sugar price will go from $9.50 to $10 to $10.50 to whatever, blah, 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 and continue to rise. Over time, it might have different elasticity. It might rise sometimes, it's still rising, but rising at a slower rate. And in other periods of time, it might rise at a very, very fast rate, like it does initially, and then here as well, right? Similarly, prices could decrease, right? And because, again, the spot prices could actually decrease over time. Alternatively, prices might bounce around. Prices might go up for a period of time, and then due to seasonal factors or just shortages or something else in the market, we might find that the prices might come off for a while, or sorry, surpluses in the market, prices might come off, and then suddenly the price might take off again. Right? So lots of different, and this is just me being silly with 3 different patterns. Right? You can have lots of different patterns that prices could evolve by over time. The price patterns where you've actually got them running in a single direction like that are sometimes easier for managers to deal with. When you've got this sort of up and down stuff, that's really hard to model that, right? Unless, of course, you've got a deliberate known seasonality that's happening in the data. So, for example, heating oil, right? Heating oil in the winter months, heating oil is very expensive. In the off months, heating oil very cheap, okay? For obvious reasons. I mean, in the middle of summer, you don't need as much heating oil, obviously, okay? So, what do we notice about these here? Well, what we'll notice is that I could be standing here today and I can form an expectation of what I think the expected spot price is likely to be. In relationship to today, I can form a view as to what I think the spot price will be, let's say at this point in time, just here. Well, if I'm thinking about the spot price at this point in time here, there is a range of possibilities. The spot price could be here, it could be here, or it could be here, right? And subject to what my expectations are, I'll form that view, and that view then becomes my view. In other words, there is a relationship between where I think the current spot price is to where the expected spot price actually is. There's a relationship between spot price and expected spot price. Alternatively, I could ring up a bank, or I could go to an exchange, and I could say to the exchange, well, for a 3-month delivery or 6-month delivery contract, what is the actual price of a forward contract? And the forward contract may be at a price that maybe 6 months might be here, might be here, might be down here, or for that matter, it might even be flat. It might have stayed constant over time. Okay? So again, the forward price could move up, could move down, could move wherever it wants to go. All right? But what I'd like to think is that the expected spot price, my expectation of where the spot price will be, is very close to where the market thinks the price should be. Ideally, you want the expected spot price to be equal to the forward price, okay? Which then runs us into a couple of things that we need to think about. The first is that when we are actually trading in financial markets, as we talked about before, spot trades always involve transactions that are basically in the now. So they're going to be transactions for immediate exchange. Forward contracts involve future unconditional transactions that normally happen, obviously, in the future. Now, looking at those relationships that I was just talking about, if the forward price is greater than the spot price. Now remember, the forward price is the price that we observe today for delivery at a future point in time in the future. So in other words, if today spot price of sugar is $9.50 per £1,000, and today the forward price, the 6-month forward price, is, let's say, $12 per pound, okay? What that tells me is that over the next 3 months, people expect the price of sugar to rise. Also, what it tells me is that I can actually lock in a contract today for delivery in 3 or 6 months' time, whatever the period is, at the price of $12. Okay, so therefore I can actually lock in what that price will actually be. Now, therefore, there has to be a relationship that exists between the current spot price at time 0 to the forward price for delivery at some future point in time, t, where it is priced today at time 0. And when that happens, we have what is called a contango. Right? That's called a contango. If alternatively, we have a different situation where the forward price at time t that's observable today is less than today's spot price, then that is a situation called backwardation. Now, go back to our diagram here. Right, today, here's where the spot price is right now. Okay, where I've got the cursor here, right now, time 0. And right now, I can observe a forward contract. And let's assume the forward contract is for maturity at this point here, right, so this time period here. And let's assume that the price in the forward contract is that point right there. As it's turned out, the prices have gone up, they've evolved, and they've landed up at that point right there. That is what we call a contango. The forward price is greater than the current spot price. Forward price is greater than the current spot price. Alternatively, let's assume that the forward price instead went on a merry path and it ended up down here instead. So in other words, at time 0, I'm observing a forward price that is less than the current spot price. Right, the forward price that is less than the current spot price, but the forward price is one I'm observing right now. Spot market $9.50. Forward price is trading at, let's say, $7. Okay. Under those circumstances, I'll be thinking there must be a big glut of sugar that's going to arrive in the market. It's going to push the prices down. Or alternatively, there's going to be a super demand for sugar or something. You know, everyone wants to drink Coca-Cola or something. Right? And there's super demand for sugar. And as a result, what happens is, of course, the forward price obviously ends up being less than what the actual spot price actually is today. Under those circumstances, we have what is called backwardation. Right? So contango versus backwardation. When I've got contango and backwardation, what you find is, though, that I also need to consider where my expected spot price actually is. My expected spot price is not just automatically what the banks tell me the forward price is equal to. My expected spot price may in fact differ from where the market tells us that price is at a point in time. So in other words, from my perspective, my expected spot price may be equal to the forward price, it may be greater than the forward price, or it might be less than what the forward price actually is. Okay, and as a result, what that means is, even though the market forward price might be here in contango, my expected spot price might be up here, or my expected spot price might have been down here. I might have just got it all wrong, and my expected spot price is obviously off with the fairies somewhere. All right. So as a result, what happens is, of course, my expected spot price might be greater than the forward, or it could be less than the forward. Well, if I bring us back to here, right, if my expected spot price at time t is less than obviously what the forward price is equal to, then the market is said to be in normal contango. Right? If it is that way around, if the forward price is greater than the expected spot price, then you'll find that the market is in normal contango. If, however, it is the opposite way around and the market is such that the expected spot price is actually higher than what the forward price is equal to on the day, that is referred to as normal backwardation. All right? Now, what is it that actually drives this? What drives those relationships? Well, it's really straightforward. It's really simple, actually, really simple concept. It's basically to do with storage and inventory. It's to do with inventory. If inventory levels today are really high, because the inventory is not being used or there is an oversupply in the market right now, then what people will do is they will stop producing that good in the future. They will cut back on their production in the future. And as they cut back on their production in the future, that will cause future prices to actually rise. Even though there's obviously a lot there now, right, a lot available right now, that what it will cause the forward price to go up. Alternatively, if you've got a massive undersupply right now, what will happen will be that in the future people will realise that undersupply is there and therefore they're likely to produce more. If they produce more, what happens to the price? It goes down. All right? So suddenly we realise that obviously in forming what our expectations are, our ability to obviously have a sense of what the dynamics are of the market, what are the factors that drive demand and supply for commodities, for example, or for interest rates or for FX. By knowing those things, we can then start to formulate what we think is likely to be the outcome in terms of where the future expected spot prices might actually be. Now, let's assume that the forward price is currently trading at, let's say, let's assume the forward price is currently trading at $10. All right? And everybody in the market thinks that the forward price should be at a price of, let's say, $9.50. All right? So we all think the price should be, our expected spot price at time t is about $9.50. The market's currently trading at $10. What are we going to do about it? All right? Well, aren't we going to trade in such a way that we're going to try and force that price of $10 in the market to try and pull it down? All right? And to pull that price down, how do we pull it down? All right? How are you going to pull it down? Well, if everyone starts selling the $10 contract, what happens to the price? Right? It'll push the price down, won't it? All right? And similarly, if everyone started to buy it, it would push the price up. All right? And so obviously by virtue of the trading strategies that traders will implement, they can actually force the actual market price to actually move. Now, people that are really good at doing this can then arbitrage the market. Let me see if I can find the concept of arbitrage here for you. Oh no, I won't do arbitrage just yet. Okay, so what we can do is we can generate the idea that, of course, the expected spot price should always be equal to what the actual forward price is going to be equal to. In order to do that, in order to achieve that, means that we need to have a strategy, a way that we can actually think about locking in the future cost, but we want to lock in the future cost in such a way that obviously how we thought about and generated the expected spot price can actually replicate what the forward price is actually doing. In other words, in order for the forward price to be equal to the expected spot price, I need to set up a relationship that exists between the current spot price and the factors that are likely to affect what the price is going to be, the price movements are going to be between now and when the forward price actually occurs. So let's think about how we might do this. Okay, sorry, just bear with me, I was going to find the slide that I wanted to show you. I jumped over some slides, didn't I? Is that the one? I did, that's the one I jumped over. Sorry. We were on that one, then I jumped over it. My apologies. There you go. All right, now, okay. If we lived in a world where forward prices were equal to expected spot prices, then what we could do is we could set up a relationship between, obviously, the forward price and the expected spot price. To do that means that we've got to understand what drives our expectation of what the current expected spot price will actually be. Now, we could use some sort of technical analysis where you look at charts and predict out what you think, or we could better still use a fundamental approach, a fundamental analysis approach. And this approach would be a very simple one. What we would say is this, that I could actually calculate what I believe the forward price should be equal to, a la the expected spot price, right, by virtue of looking at the current spot price and then multiplying that by 1 plus the cost of borrowing raised to the power of t. Now let's think about this for a second. What is it that I'm actually saying? Well, let's assume that I needed to sell some sugar 1 month from today. I need to sell some sugar 1 month from today. I could just wait until the month is up, get my sugar and sell it in the market. All right? That's a bit of a dangerous strategy though. What I could do instead is I could actually get the sugar today at today's price. I could borrow the sugar, in other words, not borrow, I could actually go and buy the sugar from the market today. In order to pay for that buying of the sugar, I borrow money. I pay for that money, of course, over a period equal to what the term of the forward contract is equal to. All right? So in other words, in order to generate obviously a price equal to what the market forward price should be, I can actually go to market, buy the sugar today, fund it by borrowing money, and then at the end of the time period, when I pay back the actual amount of, obviously the loan that I pay back, the all-up price of sugar multiplied by 1 plus r to the t should actually be equal to what the forward price is actually equal to. Trouble is though, I don't know if you've ever bought 1,000 pounds of sugar, right? You go to the shops, you buy a little, 1 kilo thing of sugar, right? Or a little 2 kilo thing, right? 1,000 pounds, my gosh, that is a lot of sugar, right? So, what do we do? Well, what that means that what we have to do also is think about the fact that we might need to store the sugar. And by storing the sugar, that's actually going to cost me money. It will cost me money to store the sugar. So I'm still going to go out and I'm still going to buy the sugar today. I'm still going to borrow, but I need to put the sugar somewhere. I need to put it in storage. And the storage, of course, might cost me a lot of money because sugar needs to be in a very dry place, and therefore it's got to be in a very specially designed sugar warehouse that I need to keep it for a period of time. All right? So how can we take that into account? Well, what we can do is we say, well, what if there's storage costs? Well, if there's storage costs, it'll be the current spot price plus the cost of storage, right? Multiply that out by 1 plus r to the t. Right? Borrow over a period of t, and we've taken account of both our spot price and our storage costs, where that storage cost, of course, is the present value of your storage costs over that period of time. The alternative approach is that you could always express your storage cost as a percentage of obviously what your spot price is equal to. So if you express it as a percentage, then of course it'll just be the spot price multiplied by 1 plus r plus c, right? And then, of course, that will become, because the R, remember, is a borrowing cost, the storage is still a cost, and so therefore it's plus C to the power of T. Now, with some commodities, during the life of the commodity, what I can do is I can actually do two things. One is I can actually obviously store the commodity itself. Very good. Okay, I can actually store the commodity for a period of time, but with some commodities I can actually lease out the commodity to other people to use it as collateral. Gold is a good example of that. I can actually put my gold in storage at somewhere like the Perth Mint, right? But then what happens is that while the gold is in storage at the Perth Mint, I can actually allow other people to lease the gold. They can lease the gold from me during the period while the mint is actually holding the gold. The lease would only run to obviously the end of the life of when I'm actually going to physically sell the gold, but of course the lease itself. Now, when they lease gold, that doesn't mean they get to take the gold and use it and show the gold bar around all their friends and whatever else. What it means is they get the rights to that gold. In other words, what they could do is they might have a collateral issue that they need to solve. And what they do is they lease the gold and then offer that gold as collateral. Okay? And when they offer the gold as collateral, you don't have to physically give the bar of gold over as collateral. You've just got to be able to demonstrate that you've got access to that particular gold if you should fail in what you're doing. Therefore, by leasing the gold, right, that means that for me, I pay the cost of storage, but I actually get a benefit. I get a benefit that flows to me through the fact that you've actually been able to do that. And so, as a result, we see the following. That I could now have my cost of storage, so my spot price, plus the cost of storage, multiplied by 1 plus R, the borrowing cost. Now we have this other thing called minus Q. And Q represents, obviously, the dollar value of the lease relative to the spot price. Right? The dollar value of the lease relative to the spot price is a percentage of the spot price. So you can actually work out what your return is going to be that you'll get from leasing whatever the commodity is. Then what we can do is we can do the following. We can go, okay, rather than do that, again, we could put the commodity price in there as a percentage of the spot. And notice how we're starting to develop something up here. We can go spot, right, multiplied by 1 plus the borrowing cost, plus the cost of storage, minus any disbursements that we might actually get from having the actual outcome as well, all to the power of t. And then one last one, which is we also have another concept, a concept that comes from economics. It's almost like a concept that is sort of, it's in finance as well, obviously, but it's a concept that really goes to the idea that as a firm, that we know that there are certain advantages that come through the fact that you've actually already got the commodity. So if I've physically already got the commodity, that brings certain benefits to me. If I don't have the commodity and I've got to go and get the commodity, that can work against me. So there could actually be a cost associated with doing that. So in other words, if I've actually got all that sugar sitting in storage, okay, I have what is called a convenience yield. And a convenience yield should actually decrease what my costs are associated with obviously borrowing and storage. Because there's a benefit that comes to me, so it should actually decrease what is occurring. But if I don't have access to the commodity, then that means the convenience yield can actually work against me. So in other words, convenience yields can either be positive or they can actually be negative. Right? They can actually be positive, but they can also be negative. So if they're actually in my favour, then that's going to reduce my costs here. But obviously, if they're against me, then that will become minus a minus, so it'll become minus minus y, which then means that, of course, it becomes a positive, which increases my total cost. All right? Now, I've given you a couple of things to think about in the work that you've got there, to obviously think about that, and that's a good thing to do. Now, again, a reminder to everybody, no lecture next Monday. We're going to pick it up at this point again next Monday, and then we're going to talk more specifically about the management part of commodity price risk, and then we'll talk about FX and interest rates next week, all right? Or in week 8. Week 8. Unbelievable. We're halfway through the course. Unbelievable. All right, everybody. I hope you all do well next week. I'm sure you will. Hello.
Yeah. Here, this sum is the sum of unexpected loss.
Yes.
And why do we need to contain this term?
Oh, okay. Because what we've got to do is we've got to take account of the correlations that exist.
Yes. This is the formula. Yes.
Yeah, no. But this is okay. Go back. Take it out. Yeah. If all I do is, can I just scroll down there? Yeah. If all I do is, I just simply add these numbers together. Okay.
Yeah.
These numbers together, all they are doing is telling me what the actual sum is of the individual unexpected losses. It tells me nothing about the correlations or covariance structure of all my loans.
Yes.
Right? And that's why we do this other adjustment here.
I know why do we need to calculate the correlation, but why do we need to contain this term? Because in the formula there is no this term.
Well, it is there because it's there by virtue of the fact that you're correlated against yourself.